Okay, good afternoon, all of you.
Good afternoon,
Good
ma'am.
afternoon, ma'am.
Ma'am.
Good afternoon. So I'm audible and you can see the presentation, right?
Yes, ma'am.
So let's start. Though not many people have joined, but let us start. So we're going to start a new topic today, which is deposit products and operations. Some of the things we have seen earlier as well. So what do you understand by deposit products? What are deposit products? And how they can be classified?
Deposit products like gold.
Deposit products are like gold. For a bank?
Ma'am, we are talking about a bank or
Whatever we are talking about, but how can a deposit product be gold?
ma'am, deposit not in terms of loans, we can say that.
Deposits are loans?
No, gold can be a product of loan.
Yeah.
Not a
So we are
deposit.
talking about deposit product. What do you understand by deposit
Yes,
product?
Cash.
What is deposit? Cash is a deposit product. But where will you keep your cash?
We keep our cash in a bank, in our saving account.
Saving account. So where you keep money are your deposit accounts. So are they liabilities or assets for a bank? What are they?
They are the liabilities for a bank.
Yes. Deposit products are liability products for the bank because the bank is accepting deposit, or you can say the bank is borrowing the money from the depositors, and in lieu of that they give an interest. So bank is using the money owned by someone else. So these are liabilities for the bank. How do you classify deposits? What's the classification of deposits?
Long-term deposit, short-term deposit.
Okay, long-term deposit and short-term deposit. What is the actual nomenclature we use? Anyone?
Time deposit and fixed deposit.
No, time deposit and fixed deposit is the same.
Oh, sorry, time deposit and demand deposit.
Right. So deposits products can be classified in two ways. One are time deposit and the other is demand deposit. What is the difference?
Demand deposit are those deposits which whenever we demand for it, they were given by the bank to us. And time deposit are those deposits they were given by the bank after a period of time.
After a period of time. And even if the bank gives you immediately, the bank is going to charge you penalty or will levy some kind of charge.
Interest. Yeah.
Yeah. So deposit products, as we have understood, are the products which are the liability products for the bank. They can be classified into two major categories: demand deposits or time deposits. Demand deposit, as the name suggests, are deposits which can be withdrawn on demand. That is, as and when the customer wants, he can go to the bank and withdraw. Saving account and current account are demand deposit, or collectively known as CASA, are demand deposit, where the customer can withdraw the money by any time he wants. On the other hand, the bank also accepts some time deposits, which are payable only after a period of time. So recurring deposit, fixed deposit are example of time deposit. Okay, so in this session, we are going to understand more about saving account, current account, deposit and deposit account operations. We'll look at the interest calculation of deposit account. Also, this is a part of retail banking. So we've seen in an economy, individuals are the net savers. So individuals have money in surplus, which they want to either keep with the bank or invest. Now, bank has been trying to be a provider of all kind of service, or what we in banking parlance call universal banking. Banks in today's time want to be universal banks. That means they want to provide all financial products under one roof. So they also distribute third-party products and service. We are also going to look at regulation governing deposit products. So this we have seen earlier as well. We have seen the primary function of a commercial bank. What are the other kind of bank? One is commercial bank. What is the other kind of bank?
Corporate bank and retail bank.
Cooperative bank. And
Oh, sorry.
retail bank is a part
Investment
of
bank.
investment
Yeah,
bank.
investment bank.
Correct. So what is the difference between investment bank and a commercial bank? Do they perform the same function?
No, ma'am.
No,
Generally,
ma'am.
investment banks do not accept deposits from public,
Correct. Correct.
whereas commercial banks will accept.
Correct. That is the main difference between investment bank and commercial banks. Commercial banks are in the business of accepting deposits and lending it. Right. So this is the main function of the a commercial bank, where they accept deposits in form of either demand deposit or time deposit, and then they further lend it to earn some income out of this. In this process, they also create credit and assets. So I think by now all of us know what does credit mean. What is credit?
Credit means loan.
Credit means loan. So what is the issue? Akshay and Hari Prasad have not joined in. Are they aware that we will start?
Yeah, ma'am.
the
I
class
don't
at
think
2
so.
o'clock?
Ma'am, I don't think so. Hari Prasad is aware of the timings, ma'am.
Okay, because it is in the group.
Yeah,
Okay,
but
Akshay has just joined.
okay.
Can you please inform him? Send him a message that we have the class from 2 o'clock.
Yes, ma'am. I will do that.
Okay, please do. Akshay has just joined.
Yeah.
Akshay, you forgot we have the class at 2 o'clock today? Akshay? Akshay, you joined in late? Anyways. Okay, so this is the function of a commercial bank. Investment banks, on the other hand, as we have seen, provide investment services, which means they help corporate raise money. Also, they help HNIs to plan their investments. So you have commercial bank accepts various type of deposits. So you have the saving account, recurring account, fixed deposits. In business, you have current account, checking account. Actually, in India, we call it current account. Account which allows unlimited number of transactions. And also we have seen that demand deposits are payable on demand. So accounts like saving account, current account, the money kept in these is to be payable, has to be paid whenever the customer demands it. And therefore the bank also gives you a checkbook or a card for withdrawing money at your own will. Whereas fixed deposit or recurring deposit can be only withdrawn after a period of time. Now, why should we keep our money with the bank? Would you want to answer this question? Why is that we have to keep our money with the bank?
We keep our money with bank for safety.
For safety, okay.
For
To earn
getting,
interest.
for, yeah, to
Get
earn
interest, okay. For a return, yes. Also for liquidity. In today's time, anywhere banking, wherever we go, we can access our account. So we keep the money there. What is the broader advantage of individual keeping their money with the bank? Why do you think there is an emphasis on financial inclusion and people keeping their money in the bank? What is the ultimate motive? Or what is the bigger gain? Liquidity, okay. But the bigger benefit of people keeping their money with the bank,
or
not individual benefits, benefit to the country. Does it have any benefit to the country? If people keep their money with the bank, does it have any benefit?
yes, ma'am, it
And people can take loan from bank.
It
Okay.
increase the economy, means commercial bank with the deposit can increase the money in the economy.
Correct. So this money which is lying idle with
Credit
people
multiplier.
can be channelized through the bank to be given to people who are in need of it for the development of the economy. So individual level, yes, there are benefits of individual open accounts, but individuals opening account and keeping their money in the bank has a bigger picture. It also helps the economy to grow. And that's why you will see RBI, the government, time and again keep on taking various initiatives to include people in the in the fold of banking. So these things we have seen: safety, liquidity, returns, and also the banks play a very important role in the development of the economy. So banks are safer, offer liquidity and good return. They fulfill the expectation from a depositor. Safety, banks are considered to be the safest and most trustworthy institution. This belief attracts depositor at relatively cheaper rates. Liquidity, banks have large resources and are able to allow withdrawal even on fixed deposits. Return is a function of safety and liquidity. Higher the level of safety, the liquidity, lower is the return and vice versa. So if you look at the return which a bank gives, it is very moderate compared to others. But you know, bank is safer. Why do you think bank is safer? Why
Because
do you
it's
think
a
bank is
government
safer
body.
than other financial institutions?
Because
Yeah.
generally they are the government body. If we are talking about public sector banks.
Okay, but HDFC and ICICI Bank are also secure.
Yes, ma'am.
They are not public sector banks, but they are also secure.
Secure.
And they are regulated by RBI.
Yeah, so the regulations in banking sector are very strong. Also, we know that there is an insurance, no? Insurance on the deposits which you keep. Have you not seen the DICGC insurance? Deposit Insurance Credit Guarantee Corporation of India. I think we have discussed earlier.
Ma'am,
No,
Yeah?
ma'am.
No.
Yes, ma'am. Once you have talked about it.
Yes. So the deposit which you keep with the bank are insured up to 5 lakhs.
Yes, ma'am.
Yeah, I think we have spoken about
Yeah,
it.
yes, ma'am.
Yeah, and it is in the newspaper also.
Yes, ma'am.
The ICGC. So the
Yes,
insurance,
ma'am.
the deposits which you keep with the bank are also insured.
Yes, ma'am.
That's why
Even
they
we
are safer
discussed.
than any other kind of investment.
Yes, ma'am. We discussed about one example of any bank was become bankrupt.
Yes.
So
Yeah.
we are saying that RBI whether interrupt, why didn't interrupt in this?
Correct. And if you've been reading the newspaper, you would read that now DICGC has stepped in and they say people, depositors of the PMC bank are
Yes,
going to
ma'am.
get money by November if you're reading the newspaper. Right? So we know that there is DICGC insurance also on the deposits accepted by the bank. So therefore the deposits of the bank are safer than any other investment. So banks are preferred over other financial institutions because they are safer. They are not all government bodies, but they are controlled by RBI. They have huge liquidity, and we will see gradually, or we've been seeing that there is a inverse relationship between liquidity and risk. So more the liquidity, lesser would be the risk. Liquidity means you can withdraw your money easily. So obviously, the moment you feel that there's a problem, you can just withdraw your money and save yourself from the risk. So the liquidity in bank is very high. Therefore, the risk is low. The banks also offer competitive interest rates. If you look at newer banks like IDFC, Bandhan, you will see they are offering better interest rates than the existing banks to attract the customers. So they also offer competitive interest rates. And we have private sector banks as well. So another function of the bank is making advances, credit, loan, facility, exposure, all this means loan. Okay, so making advances, The bank also makes advances or gives out loans. So that is the primary function. We've been seeing it for a long time now. The primary function of the bank is accepting deposit and lending out. So at one hand, the bank will accept deposits in either demand deposit or time deposit. On the other hand, the bank will lend. What will happen if the bank doesn't lend? What is the biggest disadvantage of not lending?
They will not earn interest.
Correct. Yeah. So if for that for bank again, it will become idle funds, and idle funds are obviously loss-making proposition. So if the bank doesn't lend, it will not be able to generate the interest income. So advances is the other part of the bank function of giving out loans. So if you look at the definition of section 6 of the Banking Regulation Act, it clearly says that banking is an institution which borrows money with the purpose of further lending. So the bank will not keep the money with them. They will further lend it in form of advances. So advances also can be of different types. Some of them are secure, some of them are unsecure, but the bank lends out loans. Yeah, so the commercial bank provide loans and advances of various forms. It can be overdraft facility. What is overdraft?
Commercial bank provide overdraft facility means they will give us the amount in our account, so we
Yeah.
can over withdraw from our deposit. On the over withdrawal money, they charge interest.
Yeah. So overdraft means to overdraw your account. So draw more than you actually have in your account. So overdraft means that. Cash credit is a facility provided to businesses where the business, what is usually a business model, the businessman will manufacture something, sell it out, for which he'll receive cash, and that cash has to be deposited with the bank. So we've seen the working capital cycle or the working of a business where the bank needs money to complete its production cycle and then sell its produce to recover the money. So that happens in banking as well. That means the bank lends money for the business activity, and the money is returned after the money is materialized, right? So that is cash credit. Bill discounting. Now the bill which we are talking here is the bills of exchange. We are not talking about the receipt or the bill which we get when we go for shopping or something. No, the bill we are talking is bill of exchange. These are payment instruments. So they are specially used in international trade. So banks a lot of time give loan on bill of exchange, right? So for example, A is the buyer and B is the seller. Now B has sold the goods to A on credit. What will selling the goods at credit mean? What would you mean by when I say that the B has sold goods to A on credit?
Means we sell the goods to A on credit, means on loan. On means
Payment
not
has
for
not been
cash.
completed. Yeah,
not
payment
for
has.
cash.
Yeah, not for cash. That means we have not received the money.
Yes, ma'am.
Yes, payment has not been completed.
Payment has not come. Yeah, but B obviously is not going to leave like that. We will tell A to draw a bill of exchange, right?
Yes, ma'am.
So bill of exchange can also be a check. In business, however, you have a bill of exchange where A will tell somebody to make the payment to B. Now that person might not pay B immediately, but that person has a lot of credibility in the society. In that case, a bank would be ready to lend. So for example, B will receive the payment only after 15 days. B goes to the bank. The bank says, okay, I'll collect this bill and I'll give you an advance. Okay, however, I'm going to charge some commission. So because that is an income for the bank. And until the bill is paid, it will it will remain like a loan. So bank also provide this facility of bill discounting. When we read about corporate banking, we're going to understand bill discounting in little more detail, but bill discounting is basically providing loan on a bills payable. The way bank accepts demand deposit and time deposit, similarly the loans also are demand loans and time loans. So demand loans are short-term loans, whereas time loans are term loans are longer term loans. Right? The bank has to balance its liquidity, no? So it is accepting some deposits which have to be payable at any point in time, and some deposits are payable after a certain period of time. So to match it, the bank also gives out demand loans and term loans. So these are some kind of advanced facilities given by banks. So we have seen the bank enable credit creation. Credit creation would be to give loan and consequently create money. So it's not that the money is increasing, but the use of money is multiplied.
Increasing.
So for example, I keep my money with the bank. The bank is going to give it as a loan to someone else. Now this person is not going to keep his money. He's going to invest it somewhere. He's going to buy certain things. This money will now pass on to a third person. That third person is going to maybe buy something or maybe save. So that way the amount of money keeps on multiplying in the system.
It means, ma'am, that
Yes, Akshay.
money will back to the bank again.
Yeah. Yeah, but it is created, it's rotated multiple times. So for example, one person has a deposit of 100 rupees. The other person has a loan of 80 rupees. Another person has a deposit of 75 rupees. Like so on and so forth. So from this example, maybe you can understand.
Okay.
Right. So bank A has accepted 1,000 rupees, and given 900 as loan. Okay. Then this 900 again comes, it is deposited in bank B. Bank will give 810 rupees. This money will be deposited in bank C, which gives additional loan. So this way the amount of money keeps on increasing. So we started with 1,000, but now it has become 10,000. So that is what credit creation is. So while sanctioning a loan to customer, a bank does not provide cash to the borrower. Instead, it opens a deposit account from where the borrower can withdraw. In other words, while sanctioning a loan, a bank automatically creates deposit. And this is the most significant functions of a commercial bank. Checking account in India, we don't call it checking account, we call current account, which are accounts which do not have any limit on the number of transactions. So in a current account, you can do any number of transactions. Liquidity is very high. And what is the relationship between liquidity and return?
Liquidity, opposite relationship between liquidity and the return. More liquidity, less return.
Correct.
Inverse.
Yeah. So liquidity and return have inverse relationship. So for a checking account or a current account, the liquidity is very high. So what will be the returns?
Low.
No. No return, in fact.
So liquidity is high, yes. And see, if you compare fixed deposit to a saving account, so saving account, you have a restriction on the number of transactions. So liquidity is still limited, right? So your return is better than lesser than the fixed deposit. With current account, there is no restriction. So current account is highly liquid, and therefore the return is zero. That's why most of the banks do not pay interest on the amount in a current account, right? Because they're very liquid. The money hardly remains with the bank, and therefore the bank does not pay any interest on the balances in current. So in the last class, I had given you a task to go through various accounts and look at their products. Have you done it? Had we had spoken about it, no?
Yes, ma'am.
So did anybody go and look out the different kind of products available with the banks? Please, if some do this, because this will help you in interview preparation. You will know the different kind of accounts and what is their purpose and which bank offers what kind of account.
Yes, ma'am.
No?
Yes, sure.
So if you know, current account is a demand deposit for the bank. That means the customer can withdraw the money anytime he wants. It is also known as transactional account because it allows transaction. So a transaction account, also known as a check or check account in North America, it's a transactional account is known as current account or check account in UK, Hong Kong, India, and some other countries. Because money available on demand, it is also sometimes known as demand deposit. Also, current accounts may allow borrowing via an overdraft facility. So as I told you, there is no restriction on the number of transactions in a current account. So it helps businessmen. So it's opened by businessmen who have a high number of regular transactions with the bank. It includes deposit, withdrawal, and contra transactions. Contra is corresponding transaction. Current account, as we know, is known as demand deposit because the money is withdrawable on demand. It can be opened with cooperative banks or commercial banks. Suitable for providing liquidity to the business and for receiving and making payments. So it is also suitable for making payments to creditor by using checks. Also, banks allow overdraft facility to current account holder, not to everyone, but to the select few. The bank allows overdraft facility. That means the customer can withdraw more than what he has in his account. So current account is also known as non-interest bearing bank account because there is no interest paid on the current account, on the balances in the current account. So it is non-interest bearing bank account. Usually businessmen will open a current account, but there is no restriction. Even if an individual wants to open, he can open a current account. All banks expect the customer to keep a minimum balance. So if you would have seen any of the bank site, say for example HDFC, you'll see there are many different kind of current accounts, and the minimum balance also varies. Higher the minimum balance, more are the facilities provided. So the bank provides facility whether to current account or to saving account depending on the amount they maintain with the bank. However, the bank would require a customer to maintain a minimum balance in the current account. Obviously, if the customer is unable to meet his promise of keeping the money, the bank is going to charge a penalty. And if the bank has given an overdraft, obviously the bank is going to charge interest on those funds. So continuing nature, as there is no fixed period and period to hold. So that we have seen. We have seen current account is a demand deposit. That means it can be withdrawn anytime you want. It is not subject to any kind of waiting time or any kind of maturity. Continuing nature, as there is no fixed period to hold, does not promote saving habit with its current account holders because there is no interest paid. So people usually keep the money only what is required to be paid, and because there is no interest which can be earned on the balances on the current account, businesses usually withdraw that money. However, unlike a saving account, there is no restriction on the number and amount of deposit. So we've seen this is the advantage of a current account. There is no restriction on the number of transaction in a current account. So that makes it highly liquid, and which enables the businessman to conduct their business transactions smoothly. So the biggest advantage of current account is the businessman can do all his transaction without any restriction. It also provides liquidity and accessibility to your fund. So current account is open for businessmen that have large number of daily banking transactions, that is receipt and payment. Enables businessmen to carry on out their business transaction properly and promptly. Can withdraw from their current account without any limit. No restriction on deposit. Make a direct payment to their creditors by issuing check, demand draft, or pay order. So it becomes easier for the people holding the current account to make their payment. So another advantage of current account is now what will be the advantage of current account to the bank? So we've seen the advantage of current account to the customer. What will be the advantage of current account to the bank?
And they will not have to give interest on account.
Yes, correct. So when we look at profitability of the account, the profitability of a current account is very high because the bank does not have to pay any interest in the balances kept in the current account.
And with the help of current account, bank also earn some income in terms of charges.
Yeah, so the charges on current account are very high. So current accounts are very profitable accounts to the bank. At one end, you don't have to pay any interest. Also, you are charging them for everything you do. So current accounts are quite profitable for the So enables a bank to collect money on behalf of customers and credit the same to their current accounts. Enables the current account holders to obtain overdraft. Can get credit worthy information of the current account through the interbank connection. And also, if you have to open a current account, you have to first get a no objection certificate from the existing bankers. This will tell if you that all your loans are cleared or there is no discrepancy between you and the bank, right? So in today's time, all this information is easily available. It also facilitates the industrial progress of the country. So for a business, obviously money is required, the usage of money is required. When this money can be used effectively, it will also have an impact on the economy of the country. In today's time, facilities of internet banking and mobile banking are given to the customers to carry out important business transactions with ease and quick and speed. So current account and saving account, collectively known as CASA, they are low interest deposit for the bank compared to other type of deposits. So this also comparison you should have seen. If you have looked at various products of the bank, you'll see the interest rates of saving account are much lower compared to the interest rate to be paid on the fixed deposit. So current account and saving account are relatively low interest products for the bank and therefore more profitable. So current accounts and saving accounts are low interest deposit for the bank compared to other types of deposit. To increase CASA deposit, bank offers various services such as salary account to companies, open current account, and use their cash management facilities. So when you work in a bank, your boss will come and tell you, "Aaj CASA badhana hai." You have to get CASA because CASA is a low interest deposit, and the more money you have, better would be the profitability of the bank. So CASA deposits are important in improving the profitability of the bank. And cash management facilities are facilities provided by the banks to various big corporates where the bank helps them to receive payment and make payment. So the bank makes the payments and receive payments on behalf of big corporates so that they don't get involved in this nitty-gritty every day. So they can concentrate on business and they can outsource their receiving and payment of money to a bank. So anybody can open a current account. There are no restriction of opening a current account. Only that current account cannot be opened by a minor. So a saving account can be opened by a minor because it's a deposit account. In current account, you can also have a OD facility. So individual who is less than 18 cannot open a current account. But otherwise, there are no restrictions. Most of the legal entities, all the legal entities and individuals can open current account. So current account can be opened by individual who has attained majority. It can also be opened by 2 or more individuals in their joint accounts, joint name. It can be opened by sole proprietorship concern, partnership concern, HUF, limited companies, club societies, trust executors and administrators, government and semi-government bodies, local authorities. So everybody can open a current account. That's not the case with saving account. There are restrictions on some entities which cannot open a saving account. So the mandate for saving account is clear. Saving account cannot be opened for business purposes. So any kind of business cannot open a current account. However, certain non-legal legal entities like a society, trust, and clubs can open a saving account. But there is restriction on you can open a saving account. That restriction is not there on the current account. Current account can be opened by anyone. So as I was telling you, there are a lot of choices for people to open current accounts. So even if you look at one bank, if you even look at HDFC, you'll find that they will have around 7-8 variants of the current account. So one thing is that you don't get interest on a current account. So, and you'll have to pay charges. So you'll have to look at how you can minimize those charges. So some banks have free cash deposit or free cash withdrawal, local and intercity check collection, free pay orders or demand draft, fee at par check leaves per month. So if you look at, it is business sense. So any customer who keeps whose mic is on, infant, there is some tapping voice coming from that end. I don't know your end or somewhere, but it's coming from somewhere. Anyway. Right. So depending on the money, it's like any other business. The more money you keep, the more facilities you'll get. So we know when we buy a first class ticket of a train and we buy a sleeper class ticket, we know the facilities would be different. That is with the bank as well. The more money you keep with the bank, the more facilities the bank will give you without charge. So you can go and look at the variety of current account offered by HDFC Bank, for example. You'll see the current account, basic current accounts starts probably from 25,000 minimum balance. It can go up to 5 lakhs. So obviously the person who's keeping 5 lakhs will get many more facilities than the person who's keeping 25,000. So the facility provided by the bank are dependent on the money which is kept with the bank. Also, the bank has customized the current account to meet your business. So there are some businesses which are seasonal business, or then there are some businesses which might involve export and import. So to meet the requirement of each business, the current account also have been customized. So before opening a current account, we should look at what is our purpose and what are the things the bank is giving us. So banks have a huge variety of current accounts. So even if you look, you are checking at 3 or 4 banks, you'll have to compare like 6, 7 products to find out which product suits you the best. So here is one example. So I was talking about HDFC Bank. HDFC Bank has many variants of current account. This is one of the variant. So basic structure of current account remains the same. That means there'll be no restriction on the number of transactions, and there'll be no interest paid on the deposit. However, depending on the customer profile and the balance the customer keeps, some of the facilities can be given for free. And that would depend on the type of balance you keep or the amount of balance you keep. So if you look at this slide, this is Apex current account, which is not the basic account. It is a high-end current account. So it's a high-end current account that caters to fast-growing large businesses who can derive maximum advantage from a host of benefits. Right. So if you look at the minimum deposit, it's mentioned here, is it? No, it is not mentioned. But however, the balance which will be required to be kept would be higher than the normal current account. And therefore, you will have more facilities or more services which the bank will offer. So things can be free cash deposit up to rupees 120 lakhs per month across all HDFC bank branches in your city and rupees 30 lakhs per month in other cities. Free cash withdrawal up to 50 lakhs at any of the HDFC bank branch, sorry. Free local intercity check collection and payment within HDFC bank branch location. Free payment and collection through RTGS and NEFT. Free pay order, free demand draft, and payable at all HDFC locations. 1,000 free at par check leaves. So the bank obviously will expect the customer to keep a higher balance to be able to give all these facilities. So as I told you, there is no restriction on individual opening the current account. Individual can open the current account. Even legal entities like HUF, sole proprietor, partnership, firm, private and public limited can open a current account. Now, difference between saving account and current account.
In current account, there is a more liquidity, while in saving account, there is less liquidity. In current account, there will be no return, while in saving account there return.
Low return, yeah. So saving, as the name suggests, is for encouraging people to save. And why people will save? People will save only if they think that they will get more money than what they're actually keeping in the account. So in a saving bank, saving account, you will get interest, and individuals can open. And saving account is therefore not allowed to be opened for business transactions. So saving account are most popular kind of individual accounts for the purpose of personal saving, which earns interest on the amount. The customer is provided with a check facility along with flexibility for deposit and withdrawal of funds from the account. So again, it's a demand deposit. That means there is no restriction, or there is a restriction, but in most of the cases, the customer would be allowed to withdraw money at his own will. So if you look at this chart, it tells you the difference between the current account and saving account, which we have seen, but just to further cement it, you can compare this chart. So I'll give you 2 minutes to go through this chart. If you look at the last sentence is not actually correct. Usually bank would ask you to keep minimum balance in current account and saving account as well. So there is a requirement of keeping a minimum balance in both the accounts. Some accounts, probably we're going to study more about it, like Janadhan account, you don't need to keep any balance, but other accounts, the bank will expect you to keep a minimum balance. So I hope all of you have gone through this chart. So we've seen the difference between current account and saving account is lies in the name itself. Saving account is for saving purpose, and therefore there's a small amount of interest paid on it. Saving account is opened by individuals for saving, whereas current account is opened for businesses for their transaction. However, there is no restriction on the businesses to the individuals to open a current account. However, businesses cannot open a saving account. Both of them in similar are demand deposit. However, saving account has some restriction, whereas no restriction for payment in current account. So basic objective, a current account provides a flexible payment method to business, people and entities. Saving account is to enable customers to save his or her liquid assets and also on that saving. Current account obviously will entail large number of transactions, and facility help the business to run without hurdles due to non-availability of funds and short-term deficits. Saving account have low value transaction, involve personal handling of assets, while current accounts are aimed to make the account holder free of personal handling of liquid funds. Current account, if we've seen, don't earn any interest and also have overdraft facility. Saving account can earn anywhere between 2.5 to 7%. Different banks are paying different kind of interest rates. So this is also your, you can do a little research here. So you'll see banks like HDFCs, SBIs, ICICI Bank are giving interest rate as low as 2.5%. Whereas Bandhan Bank and Yes Bank are giving 7%. So the interest paid on saving account is again deregularized. That means banks are free to decide, and usually the interest rate paid on a saving account is lower. and saving account have no overdraft facility. They need a minimum balance in the bank to keep the account active. Remember certificate of deposits? Does anybody remember?
It's a money market instrument.
Yeah, it's a money market instrument. And what is the use? Who can issue a certificate of deposit?
RBI.
RBI? No.
Bank post office.
Yes.
Banks. Banks can borrow for short term in the money market through the certificate of deposit. So certificate of deposits are not available through the branches, but certificate of deposits are short term borrowing of the bank through the money market. So we have seen the main function of the bank is borrowing with the purpose of further lending. So the bank also uses certificate of deposits to borrow. So this is for a foreign bank, where in India also you have certificate of deposit, but that is done in the money market. So there are interest bearing received for funds left with depository institutions. So again, these are CDs are more of wholesale product rather than retail product. So the amount also is higher. In India, I think it is 5 lakhs if I'm not wrong, though it's mentioned $1 million. But in India also, the CDs cannot be issued for a below a certain amount. So they are issued at a discount, redeemed at par value. Do you understand this statement? What do you mean by this statement? We have seen this kind of bonds. And what is the name for this kind of bonds?
Discounted bond.
Deep discount bonds, yes. So deep discount bonds are issued at a discount and redeemed at face value. So CDs also have the same characteristics. So issued at discount price, redeemed at par value. So for example, you have a 1,000 rupees CD, it will not be issued at 1,000 rupees, probably it will be issued at 950. And at the time of maturity, you'll be given 1,000 rupees. So 50 rupees will be your profit. So CDs are issued at discount price, redeemed at par value. They are negotiable instruments that can be sold before maturity. Typically issued with a face value of 1 million. That's not true for India. India, the amount would be different. I am not very sure as of now, but typically they'll be issued for a minimum amount. And they are short-term instrument issued for 7 days or 1 year. So it's a short-term borrowing by the bank. So advantage of CD, just like fixed deposit is safety. They offer better return than saving deposit. You have a wide selection and you have fixed predictable return. However, disadvantage, they have limited liquidity and also inflation risk. So all fixed income instruments will have inflation risk. So do you guys remember what is inflation risk?
Yes, ma'am.
What is it?
Ma'am, in the real sense, whatever we save, but our purchasing power will be decreased.
Yeah, so the decrease in the value of purchasing power of money is inflation.
Yes, ma'am.
Right? So all fixed income instruments will have inflation risk. And also we have seen inflation risk affects the real return. Right? Do you remember the relationship between nominal return, inflation, and real return?
Yes, ma'am.
What is it?
Ma'am, if there is a situation of inflation, our real return will decrease.
Yes.
Means whatever we are saving at the rate, but the inflation rate we deduct, sometimes it will be negative.
Correct. So if the inflation rate is more than the nominal return, then obviously your return would be negative.
Yes, ma'am.
Right? right? So if you look at your real return is nominal return minus inflation rate. If the inflation rate is low, obviously your real return would be high.
High.
But if the inflation rate is very high, then your real return would
Negative.
there are many instruments in the money market depending on who is borrowing. This we have seen when we're looking at financial markets. So we've seen money can be raised in the financial market or the by money market or the capital market. What is the difference between money market and capital market?
In a money market, we short-term loans were issued, while in capital market, long-term loans.
Correct. So
More than 1 year, ma'am. Capital
Yeah.
market. Short-term market, it's less than a year.
Okay, so I got finally got connected. Just a minute, I'll share the presentation. Bindu, Bindu, can you hear me? Bindu, I've been asked not to allow you to attend the class. आपका कुछ फीस का इशू चल रहा है ना?
नहीं मैम, मेरे अकाउंट से तो पैसे कट जाते हैं।
आप साक्षी से बात कर लो ना एक बार, प्लीज फिर ज्वाइन करो, बिकॉज साक्षी का मेल मेरे पास आया था। तो एक बार आप साक्षी से बात करोगे प्लीज, उसके बाद ज्वाइन करो। सॉरी, आपकी आवाज नहीं आ रही है मुझे, मैं आई कांट मेक आउट आप क्या बोल रही हैं।
मैं ये कह रही हूँ, मेरे 5 डे पर है ये लोन की, जो ये मेडिकल्स मैं करती हूँ, ये मेरे लोन करते हैं 6,600 रुपीज है, वो मेरे अकाउंट से कट जाते हैं, मुझे मैसेज आते हैं।
देखो मुझे ना आई डू नॉट हैव एक्सेस टू एनी काइंड ऑफ डेटा, तो एक बार आप साक्षी से बात कर लो ना प्लीज, क्योंकि शी स्पेसिफिकली आस्क्ड मी टू नॉट टू अलाउ यू इन द क्लास, इसलिए यू नो मुझे इतना ही पता है, दैट इज द ओनली इंस्ट्रक्शंस आई हैव। अब आपके फीस के साथ क्या हुआ है दैट आई विल नॉट नो, सो इफ यू कैन प्लीज स्पीक टू साक्षी एंड देन जॉइन बैक। एक बार साक्षी से बात कर लो ना आप। Okay. Okay. So various kind of entities borrow in the money market through various kind of instruments. So who borrows through treasury bills? Who borrows? Hello? Don't remember, guys?
Government.
Government borrows, yeah.
मैम क्या करते हैं, क्लास अटेंड या फिर आप?
हाँ, क्या बोल रहे हो?
मैम क्या आपने बोला है क्लास में?
मैंने बोला कि क्लास आप एक बार साक्षी से बात कर लो, उसके बाद क्लास ज्वाइन करो, ठीक है? साक्षी से एक बार बात कर लो, कोई तो इशू है आपका, मुझे एग्जैक्टली नहीं पता होगा, मुझे सिर्फ साक्षी ने ये बोला कि यू शुड नॉट बी अलाउड इन द क्लास, तो इसलिए प्लीज आप बात कर लो, क्योंकि मुझे एग्जैक्टली नहीं पता है कि क्या इशू।
मैम ये मेरे सारे लोन का प्रोसेस था, मैं पे कर दिया, अब इसमें क्लास का क्या ऑन लगा रही है मैम, ये बताइए। एटलीस्ट स्टार्टिंग में तो ये सब हुआ था कि लोन्स कटेंगे, तो मैंने तो ऑनलाइन सारे, मैं भी बैंक में ही हूँ, तो मुझे तो आइडिया है ना कि कैसे क्या प्रोसेस है। वो बोल रही है
वही मैं
नॉट
आपको बोल
अलाउड
रही हूँ, दैट
क्लास,
इज व्हाट
तो
आई एम
ये
सेइंग। बिंदु, ये मेरे साथ डिस्कस करने का कोई फायदा नहीं है, बिकॉज मुझे कुछ नहीं पता है इसके बारे में, है ना? आई विल नॉट नो एनीथिंग अबाउट इट। तो आप एक बार उनसे बात कर लो ना, साक्षी से। साक्षी का नंबर तो है ही है ना आपके पास? आपके पास साक्षी का तो नंबर है, आप उनसे एक बार बात कर लो। Anyways, yeah, so government borrows through treasury bills. So government borrows for longer term also and shorter term as well. So we have seen that government is one of the biggest borrower. Government is in deficit of money, and therefore it borrows. It can borrow for long term through government bonds, and in the short term the government borrows through treasury bills. Now who borrows through commercial papers? Who borrows
RBI.
through commercial papers, huh?
RBI.
No, no.
Oh, commercial
Ma'am,
paper.
banks.
Corporates.
Banks.
No, banks borrow
Corporates.
through certificate of deposits.
Okay, ma'am.
Bank borrows through certificate of deposit. Corporates borrow through commercial papers. Then call and notice. Do you remember call and notice? We have discussed earlier. What is call money and notice money? Nobody remembers. Call money and notice money is interbank borrowing. So one bank might be deficit, the other bank might be surplus. So banks borrow amongst each other through call notice. So these are short-term interbank borrowing. Okay. Repurchase agreement is your repo where a bank borrow from RBI, and certificate of deposit, which we have spoken about, or which we have seen, are the borrowing by the banks. Right. So just to recap what we have seen till now, we have seen that money can be raised for the long terms in the capital market, for the short term in the money market. Money market, depending on the type of borrower, the instrument can be classified as treasury bills if the borrowing is by the government, short-term borrowing by the government. Commercial paper is short-term borrowing by the corporates. Call money is interbank borrowing. Repurchase is repo, the borrowing by banks from RBI, and certificate of deposits are again borrowing by the bank. So money market, the money market also known as substitute for cash, because these all of them have short-term maturity, and therefore they are also known are called as substitute of cash. Right. And another thing we have to keep in mind, SEBI is the regulator of capital market, right? Whereas
Yes,
RBI is the regulator of money market.
money market.
Yeah. So financial markets, we can't say financial markets are totally regulated by SEBI. Capital market is regulated by SEBI. Money market is regulated by RBI. Even your foreign exchange market is regulated by RBI.
RBI.
Right. So a market for short-term financial assets that are close substitute of money in the primary and secondary market are money market instruments. So role of money market. Capital market allows corporates to raise long-term capital, whereas money market allows corporates or various entities to generate short-term funds. So it helps financial mobility, promotes liquidity and safety. So they are more liquid. They are for shorter terms, and therefore they are more liquid. They are dependent on demand and supply and economy in use of cash. So we have seen that, for example, you also have call money and notice money. So that is what? That is the use of cash. A bank has excess cash. Rather than keeping the cash idle, which will be loss making for the bank can go and lend it in the money market. So short-term borrowing, short-term lending can be done in the money market. So economy in use of cash. So this we have understood. We had seen earlier, capital market is for raising money for long term. Money market is transfer of liquidity or short-term liquidity. So, certificate of deposits are short-term borrowing by the bank, and term deposit are also borrowing from the bank, but they are different. They're different in the sense that CDs are negotiable. That means they can be transferred to another person, whereas term deposits are not negotiable. Maturity is only up to 1 year. Now, term deposit can vary from 7 days to 10 years. So term deposit, in India, term deposit can be kept for minimum 7 days and maximum 10 years. So they have a they can have a longer maturity. Then easy to liquidate before maturity. Term deposit difficult to liquidate before maturity. Now, why do you think CDs will be easily liquidated before maturity? What makes them more liquid, or what?
They are for short term.
No, even term deposit can be from 7 days to 7 days. They can be for 7 days. Anyone else wants to try?
They are more regulated.
No. So if you look, you see the first sentence. CDs are negotiable.
Easily
That means
transferable.
they can be transferred,
Okay.
right? They can be transferred, but term deposit cannot be transferred.
Transfer.
So only the customer can go and close the maturity beforehand, for which the bank is going to charge him penalty and all that stuff. So obviously the maturity is little lesser than CDs. CDs can be easily sold in the secondary market for money market, right? So they are traded. So if you look at the second sentence, it's written there, traded in the secondary market. Therefore, they are more liquid. So term deposit will mature only when I close it, when the borrower returns the money. But that is not the case with the CD, because the CD can be sold in the or traded in the secondary market.
Ma'am,
Yes, Infant.
ma'am, here term deposits, you refer to the time deposits, ma'am.
Yeah, term deposit, time deposit, fixed deposit. Yes, same
Okay,
thing.
okay.
Yeah, okay. So they are not traded in the secondary market. So liquidity is less, and therefore they will pay a little higher interest rate. So offer higher yield. Now we have seen that deposits are basically borrowing by the bank. Now, when the bank is borrowing, obviously it will have to pay interest apart from current account where there is no interest payable. The bank will have to pay interest on either the saving account or the fixed deposit which the bank has accepted. The calculation of interest will depend on the product type. So, for example, on a saving account, the interest is calculated every day, whereas in a deposit account, the interest is quarterly compounded. So the method of calculation of interest is dependent on the product. So every individual has a saving bank account, but pays little attention to interest earned on the balance account in this account. Some people may not even know that balance they maintain in their saving bank account earns an interest. In the past, before RBI had deregulated the saving bank interest rate, all banks were offering the same interest rate. So deregulated in the sense that RBI also used to regulate the interest rate which will be paid on saving account. So the bank had guided all the banks that they have to pay 4% on the money lying in the saving account. However, now it is deregulated. That means each bank is free to decide what is the interest rate they want to pay, and therefore you will find that different banks pay different kind of interest. So when RBI brought about changes in 2011, bank became free to decide the interest rate that they wanted to pay on there. What is time value? Do we remember anything about time value? We had seen it in detail when we were looking at capital busting and all that. Do you remember what is time value?
Ma'am, the discounting rate.
Correct. So we know the value of money today is not the same as value of money tomorrow.
Tomorrow.
Yeah, or maybe it is not the same. It was not the same even yesterday because of inflation and investment opportunity. So the money which we have today can be invested to earn more money, and therefore the time value of money would be different. So because of inflation and the investment opportunity, the time value of money is different. So we say that money has little time value because that money can be invested with the expectation of earning a positive rate of return. In other words, a rupee received today is worth more than a rupee to be received tomorrow. This is because today rupee can be invested so that we have more than 1 rupee tomorrow. So we had seen if you have to calculate future value, you have to compound it. If you have to calculate present value from future value, you have to discount. So with the same rate, what would be the present value of 1000 rupees received after 1 year? Can you calculate that?
100.
100?
100 will be interest.
100? No.
No, 100 will be an interest.
So 100 would be the interest. That's all right. What will be the value of 1000 rupees which you will receive in future? If the present value is 1000, can you calculate the future value is 1000? Can you calculate the present value?
Present value, okay.
Yeah.
We need to discount it.
We need to discount it, correct. So here we are calculating the future value, so we are compounding it. If we have to calculate the present value, then we have to discount it. So by what factor we have to discount it?
Discounting means present, the future value we have, we divided by the interest.
Correct. So in this case, we will divide it, because the interest rate is 10%, we will divide it by 1.1. So if you remember the compound interest formula, A is equal to P 1 plus
R by 100 N.
raised to N, right? So you can calculate present value from future value and future value from present value. Future value from present we usually do, but from future value you can also calculate the present value. So we had seen all this in the capital budgeting thing, where we had understood these are the calculations done by a company to know whether the project they are going to undertake would be profitable or not. So we know that there is a time value of money. Present value, as we know, is an amount of money today of the current value of a future cash flow. Future value, an amount of money at some present future time period. Period is the length of time. It can vary between a year, a month, a week, or an hour. Compensation is paid to a lender for the use of fund expressed as percentage for a period. So that is the interest rate. Interest rate, as we've seen, is the rent given by the borrower to the lender. Right, so we had seen the timelines also that will have an effect on the time value of money. So timeline is a graphical device used to clarify the time of cash flow for the investment. Each tick represents one time period. So we had seen it in quite a detail when we were looking at NPV and capital budgeting and future cash flow. So we had understood the value of money changes with time. So if you had 100 rupees extra today that you wish to invest for 1 year, if you earn 10% per year on your investment, how much will you have in 1 year? So we have all done problems on them in our school as well.
Yes,
We
ma'am.
know, yeah. So we know you'll have to multiply it by 1.1.
Yes,
And obviously, if you have to calculate present value from future value, you'll have to divide it by the same
divide
factor.
same value.
So if you extend the investment for third year, you would have, yeah, so we know this 1.10 to the power 3. And when we have to calculate future value, our present value from future value, we simply discount it or we simply divide. Yeah, so we have seen how to calculate future value of an investment. I think we have seen both. We've seen how to calculate future value and also how to calculate present value from future value. And then we have also seen annuity. Annuity is a series of normally equally spaced in time. So here, for example, EMI is an annuity. Or if somebody buys a insurance policy, a life insurance policy, if it is an annuity, that means a person would have collected a sum of money till his retirement, and from his retirement, he will start getting equal installment from his corpus. So that is an annuity. Annuity is a series of nominally equated payment equally spaced in time.
Ma'am, can we call equity like this? Ma'am, sorry, annuity like this. Say for example, if I'm buying a LIC policy,
Mhm.
so I'll be paying a certain amount of money, right?
Correct.
Yeah, so that can be that series of payments. Can we call it as an equity? Say, sorry,
So that
annuity.
is not the no, that is not annuity. That is a premium you are paying.
Okay,
Annuity is what you will get after a certain amount of time, the
okay,
equal payment.
after the
So it's
maturity.
not the money back which you get in some policy. Annuity in itself is a different kind of policy where you don't get any money uh, till your retirement. So if you look
Okay,
at, I'll just digress a little to explain it a little further. So if you look at in human life, there are two factors. The first factor is the factor of early death, which we are all aware of. So if somebody dies early in early age, obviously he will not be able to meet his financial obligations or his financial responsibilities. So for that, people buy insurance. However, one more risk of human life is late death. So we have been experiencing it in India today. So China and countries like China, Japan, US have faced it and they're still facing it, but the life expectancy in India is also rising, right? So what happens if somebody lives to be 90? He retired at 60, he has 30 more years to take care of himself. Where will the money come from? So for that also people can buy annuities,
okay,
right? So after he retires, the insurance company will keep on paying him an installment throughout his lifetime. That is an annuity. Okay,
ma'am.
so
For that,
annuity,
yeah,
yeah,
ma'am. For that, will he be charged?
uh, recharged in the sense
I like see
there are two
basically.
different products.
Okay,
In insurance, there are two different products. So one product you buy, one product a person buys to protect himself from the risk of early death. Another product a customer buys to protect himself from late death.
okay,
So
okay.
annuity is a kind of insurance product which offers you a series of nominally equal payments equally spread in time.
Ma'am, so from your example, can I take pension?
Uh, yeah, pension is also kind of annuity. Yes. Your gratuity is a kind of annuity where you save a certain amount of money over your lifetime, and then you are paid pension out of that. Correct. Pension might be a little different also, because there can be contribution by the government. In some pensions, there is contribution by the government also. So it might be a little
Yes.
different, but yeah, some kind of insurance product, yeah, some kind of pension products can be termed as annuity. Wherever you are taking a corpus and withdrawing equal installment from that corpus. I hope you understand the word corpus.
Yes.
Corpus means the total amount of money. Right? So this is the formula you can use for calculating your annuity. So the discount rate is then the present is 10%, then the present value is 100 divided by 1.10, and raised to the number of years you are keeping it, and so on and so forth. Now this is the consolidated formula. Now future value of annuity we can find out, obviously. We'll have to discount it by 10%. So formula is the same, you just rearrange it to get the value you're looking at. So continuous compounding is a mathematical limit that compound interest can reach if it is calculated and reinvested into an account balance over a theoretically infinite period of time. So if it is infinite, it would be 2.7183. So constant approximated to 2.7183. We don't need all these calculations. So this we have understood. Annual compounding, semi-annual compounding, quarterly compounding, monthly compounding, daily compounding, continuous compounding, right? So continuous compounding, obviously you'll take the factor as 2.7183, whereas annual compounding, you'll do it once, semi-annually, you'll do it twice. So you'll divide the interest rate by 2 and raise it to the power of 2. Quarterly compounding, you will divide the interest by 4. That means you're doing it 4 times in a year. So 4 is the number of times you are compounding. Then monthly compounding, obviously you'll do it for 12 times, 1 each month. Daily would be 365, and continuous compounding, the factor is 2.71. So,
Ma'am, semi-annual is half yearly, right?
Semi-annually is half yearly, correct. So that is what it is. Okay. Now, when a customer opens an account with you or buys an investment product with you, the first is compliance. Compliance is to follow the guidelines of the regulator for opening an account. So what is the biggest risk when a customer is making an investment, or a customer is opening an account? What is the biggest risk for the entity, not for the customer? What can go wrong?
Ma'am, account in the
Money
sense
laundering.
Money laundering, correct. So money laundering and frauds or illegal transfer of money, right? So the first thing we'll have to do is to put a break there. So all the regulator says that you cannot form a relationship with the customer without knowing the customer. So we are all aware about KYC, not only in the banking industry or the financial industry. You see KYC while taking a telephone connection, for example, or even a gas connection, you need to do your KYC, right? So for any kind of financial transaction, the first thing we need to do is the KYC, or know your customer. So even if you are, if you're working in a bank, or even if you are an investment advisor, you must follow know your customer procedures set out by SEBI. These include the requirement to have client acceptance policies that identify the types of client that are dealing with, and then apply appropriate client due diligence measures. So we have seen this in the last session, where we had seen KYC does not only mean customer identification. It has four things to be seen. Does anybody remember the four pillars of KYC?
Ma'am, customer acceptance.
Customer acceptance policy,
Ma'am,
correct? Then
Customer identification
customer
and
identification
CDD and
policy.
EDD.
Then the other two,
And customer
and verification and transaction monitoring.
diligence and
risk categorization and transaction monitoring. So KYC is a continuous process, and we had seen we have to do a due diligence. That means do the required check before accepting a customer as a person as a customer. And in case the risk is high, then we'll have to do an enhanced due diligence. So this includes the requirement to have client acceptance policies that identify the type of client they are dealing with, and then apply appropriate client due diligence measures. So at the time of initial client account opening, the client due diligence measures which you'll have to take is obviously the identification and verification. Also, in case the account is opened by somebody else, then you will have to be need to know about the beneficial ownership. And as we've seen, KYC is not a one-time process. It is an ongoing due diligence. So it is an ongoing process, because you have to continuously monitor the transaction, for example, in a bank, to see if they are in line with the customer profile. So customer identification would mean to obtain sufficient information in order to identify person who beneficially own or control the security. Then verify the client identity using reliable independent source documents, data of information. Understand the ownership and control structure of the client. And therefore, it is very important to know the type of client. If you remember in the last session, we have seen different kind of customers. We have seen it can be individual, it can be a sole proprietor, it can be an HUF or a corporate. So depending on your KYC documentation would be dependent on the type of entity, type of customer. Now, in case a customer is opening an account for another person, in that case, you have to be extra careful. So beneficial ownership, this applies where someone is undertaking a transaction for another person, or another person owns or controls the funds or assets. Obtain adequate verification of their authority to act and the parameters for operations of the account. In such cases, it is also necessary to identify and verify the beneficial owner using the client identification and verification process. So we have seen we have to identify the customer, and in case somebody else is opening the account for somebody else, you have to be even more careful. So due diligence only is not sufficient. We have to look at ongoing due diligence, which means conduct on ongoing due diligence and scrutiny of transactions and account throughout the course of the business relationship. This is to ensure that transactions undertaken are consistent with intermediary knowledge of the client, his business and risk profile. It should also take into account, where necessary, the client sources of funds. So we had seen this whenever you are opening an account of the bank, or you are making an investment for the customer, you need to know him well, right? And knowing him well means knowing his identity and identification, and also knowing his source of income. And as we've seen, wherever there's a known source of income, the risk is less. So the customer can be classified as a low risk customer. However, if the source of fund is not known, he becomes a high risk customer. So we need to know where the money is coming for the customer. And we have to also ensure that no account is open in a fictitious or benami name or an anonymous basis. No account is open where the intermediary is unable to apply appropriate customer due diligence measure or in doubt. Instead, the intermediary should file a suspicious activity report. So, if you look at the account opening form, it has a column where you are supposed to sign, or the person who's opening the account is supposed to undertake that he has actually met the person who is opening the account, right? That no Benami account is an anonymous account, which you have a name, but you are not aware if this person exists or not. So whichever account you're opening, you have to ensure that the customer exists by meeting it. Check should take place before opening of an account. Criminal background or is banned by any enforced agency. Record keeping is an essential component of the audit trail. So from where you will know criminal background or banned entity? So this is as per your customer acceptance policy. So the bank will have a clearly laid out policy that they are not going to open accounts for criminals or people identified by a terrorist group, for example, or religious fundamentalists. So the bank can refuse to open account in their name. Also, whenever the bank is opening an account, they need to ensure to take proper identification of the client. The client identification and verification process should use reliable sources, including documents, information to satisfactorily establish the identity of each new client and the purpose of intended nature of the relationship. The intermediary should inspect original document and take copies to demonstrate to the regulatory or enforcement authorities that due diligence was observed. If a prospective client fails to provide satisfactory evidence of identity, the intermediary should submit a suspicious activity report. Also, retention of all documents is required, because in case there is a problem, you can go back and check what were the documents taken to verify the identity of the customer. So retention of important documents for future investigation, if any. Then you have the KYC risk profiling. So accordingly, it has adapted anti-money laundering laws and incorporated them in the financial system. So Financial Action Task Force is an international agency which looks at combating money laundering and especially terrorist financing. So this became even stronger after the 9/11 attack in the US. So for that attack, obviously a lot of money was required, and the money was gathered through terrorist financing, and for any kind of terrorist activity or any kind of illegal activity, you require money. So these regulations are to prevent the use of money for illegal activities. India is one of the signatories of the International Financial Action Task Force, and accordingly, it has adapted anti-money laundering laws and incorporated them into the financial systems. The KYC is an operative part of Prevention of Money Laundering Act, or PMLA Act. Must be followed to ensure compliance with anti-money laundering rules. Involves verification of proof of identity and proof of residence of the customer using suitable documentary proof. So this you would have seen, when you take a SIM, you have to give your ID address proof. Or in today's time, they take the thumb impression so that they can match it with the Aadhaar database. Aadhaar has both your details. It has your ID as well as address. So newer technologies are being used for doing KYC, but the fact remains the same that whenever you're opening an account of a customer, you have to know about the customer, his ID address, and and have documentary proof for that. Also, it requires in-person verification. In-person verification means meeting the customer. So this will prevent opening of anonymous account or Benami account. So the procedure requires an in-person verification of customer and the name, designation, organization, and signature to be recorded on the KYC form. So everybody involved with financial services and even some non-financial services require your KYC. So the government is also thinking of doing KYC when people are buying, ornaments or jewelry. That will also prevent tax evasion. At least it will prevent. So anyways, in any kind of financial transaction, your risk profiling is required. So bank, depository companies, insurance companies, post office, brokers, and other financial institutions must undertake in-person verification. When you are doing multiple investment, doing the KYC every time becomes cumbersome. So in that case, SEBI has given the liberty of doing the KYC once and then using the KYC reference number for your subsequent investment. So there are KYC registration agencies where you can register yourself and then use that registration number for doing your subsequent investors. So investors in mutual fund must complete the formalities with the KYC registration agency. The eKYC service of UIDI has been recognized as a valid process for KYC verification. So I don't know how many of you have a GIM, you have a GeoSIM. Does anybody has taken a GeoSIM? Anybody has a GeoSIM?
Yes, ma'am, I have.
Yes, ma'am.
Yeah. Did you do your Aadhaar KYC there? How did you take your GIM SIM of Geo?
Ma'am, through Aadhaar.
Yes,
Through
ma'am.
Aadhaar, na?
Yeah.
So this person comes visiting you with a small machine where you have to put your thumb. The data is picked up from that and matched with the
Yes.
Aadhaar database, and the KYC is done. Did you did you take that SIM like that?
Yeah,
Yes,
yeah, ma'am.
like that only, ma'am.
Yeah, so that is eKYC. So banks have also started it. So banks, and especially Kotak Mahindra is very active on this. They have a special account where eKYC is done and account is opened. So the eKYC service of UIDI has been recognized as a valid process for KYC verification. Here the customer has the authority. The customer has to authorize the intermediary to access the identity and address data. So even the customers who are subscribing to NPS, what is NPS?
National Pension Scheme.
Yeah, or new pension scheme. Yeah, so this is a newer product. So even for that, the KYC has to be done. So investors subscribing to NPS will have the KYC process conducted by the point of presence services. 2 sets of proof of identity are required. One being retained by the service provider and other forwarded to Central Record Keeping Agency of the National Pension System. And as investors may deal with multiple capital market intermediaries, SEBI has introduced a centralized KYC, which I just spoke about. So SEBI has introduced now centralized KYC where once the investor is registered, he does not have to do KYC again and again. So registration agencies that maintain and makes available the information provided by the customer to intermediaries covered by the scheme. So other mandatory requirement, important points to be filled in an application form to avoid KYC rejection. There are restrictions on the number of joint holders to an account. In most of it, you can have maximum 3 holders. That means one of the first holder and 2 more. So the name of the first holder is used to create the investment record, and all payouts such as dividend, interest, and redemptions are made to the first name holder. Details of all joint holders are, however, maintained in the record. So when you're opening an account, KYC of everyone would be done. Earlier, that was not the practice. Earlier, the KYC was done only for the first name holder, and the rest did not have to provide the KYC. However, now, because of the instances of money laundering and frauds happening, the regulators have asked that KYC of each individual customer would be done. So even the KYC or all the documents of the first, the second, and the third holder would be taken. So name of the first holder is used to create the investment record, and all payouts such as dividend, interest, and redemptions are made to the first name holders. Details of joint holders are, however, maintained in the record. Fixed deposit, the senior savings scheme, and national savings certificates can be held jointly by 2 holders. NPS account is NPS and PPF account can be opened only in the name of single subscriber. So it cannot be a joint account. An NPS account is held in the sole name of the subscriber. In case of mutual funds, shareholders, shares and bonds, demat account and saving account, the maximum number of holder is 3. So you cannot now have more than 3 holders, because then it will complicate the matter. So banks and investment advisors, everybody have to be careful about the KYC. That means that you have to take sufficient information to ensure that any kind of fraud or scam or terrorist financing or money laundering or tax evasion will not be done from the customer's end. So investment advisors must ensure that they obtain sufficient and appropriate information from client that enable them to assess accurately the risk profile of a client. So collect sufficient information, process of assess risk profile of the client, communicate the result to the client. So obviously for risk profiling, you'll have to first collect the information and then do an analysis to find the what is the risk for the customer. So first is information collection. The investment advisor or the banker also shall ensure that it obtains from the client such information as is necessary for the purpose of giving investment advice, including age, investment objective, time for which they wish to stay invested, and the purpose of the investment, income details. Now this is a different kind of risk profiling. It is not the risk of money laundering, it's the risk of the customer, the kind of financial risk the customer can take. So we are going to read it in detail when we actually look at financial planning. As of now, just understand that we have to understand both the risk which the customer poses to the investor, to the institution, and the risk the investor is exposed to when he is investing. So when we are looking at relationship building or wealth management or investment management, we have to look at risk from both the point of view, from the point of view of the bank or the financial institution, and also from the point of view of the customer. So this is more about financial planning. Probably it might not be very understandable for you as of here, because we are basically looking at the risk of money laundering and tax evasion and terrorist financing here. But when we look at financial management, probably this would be clearer. So what we are trying to say here is, when we are looking at investment advice, we have to also look at the risk of the risk which various kind of investment pose to a customer. So we've seen that fixed income securities are less risky because they have a fixed rate of return, whereas shares are high. The risk is high because there's no surety. They are very volatile. So we even have to analyze that. So accurately identify gaps between a client's financial resource, their appetite for risk, and the time frame to achieve their objective. Our younger client focus is on wealth accumulation, and older clients are more concerned with income. A younger client would usually be considered to have a more aggressive risk profile than the older client. And the financial advice we are given should be suitable. So we can't tell a 65-year-old to invest all his money in shares, but because at 65 he's retired, he does not have a regular income. What he is looking at generating some kind of income from his investment. So obviously we cannot take the risk of investing his money in equity because the risk is very high. So whenever we are advising the customer for investment, we also have to look at the suitability of that advice. And also SEBI mandates that whenever you are giving an advice to the customer, you need to do a profiling and maintain record of that. So you just can't say that I felt like doing that investment for the investor, so I told him. No, you have to analyze the customer's requirement and then to give him the financial advice. So, and always acting in client's best interest is a fundamental requirement of all financial advisors. To do so, the investment advisors must ensure that they have sufficient information to be able to advise the client in order to select suitable investment to meet their needs. What it demands as an overriding requirement from the financial advisor is that they conduct themselves in such a way that they put the interest of clients first and demands of his firm and their own interests second.
Ma'am,
Yes.
ma'am, can we have break?
Okay, we'll have a break. I was thinking of a break at 4 o'clock so that we have exactly, midway, we stop midway. Yeah. Can we just stretch it for 1 more minute?
Yeah, sure, ma'am.
Okay.
Yes, ma'am.
So let's have a break at 4 o'clock and then come back by 4:15. Yeah. Or okay, fine. Let us have a break now and come back at 4:15.
Okay, ma'am.
Okay.
Okay, so are we back?
Yes,
Uh-huh.
Yes,
ma'am.
ma'am.
Yeah, two people are still not back, but anyways, let us start. Okay. So what we need to understand is we have to look at the risk from both the perspective, from the perspective of the customer. So whatever advice, investment advice we are giving him should be in accordance with his risk profile. Also, we have to look at the risk the customer poses to the bank. The risk, what are the risks the customer poses to the bank or the financial institutions? Are there any risks which the customer poses to the bank?
Means how much risk the customer is able to
No,
bear.
that is risk profiling from the point of view of the customer. How much risk the customer can take is risk profiling from the point of view of the customer.
Okay,
Does the
ma'am.
customer pose any risk to the bank or the financial institution?
Yes, ma'am.
Give me-
Money laundering.
Correct. Money laundering, fraud, scams,
Yes, ma'am.
terrorist financing, tax evasion. These are the risks which the customer face. So we have to look at the customer from both the point of both risks, right? So we should ensure that we have done proper KYC of the customer to minimize the risk. Also, we should ensure that we know the customer enough to give him an advice about investment only after looking at his risk profile. So we have to do a suitability check. So we have to do a suitability check, ensuring that the investment advice is appropriate to the risk profile of the customer. Understand the nature and risk of products or assets selected. So what are the different kind of assets? What
For
are
a
the
bank,
No, for the customer. When we are advising the customer for investment, what are the different kind of assets?
uh,
What are the
equity,
different asset classes? We've seen this. No one.
equity means
Equity, yeah, fixed income instruments,
yes, ma'am.
real estate, gold,
Yes, ma'am. Yes, ma'am.
private equity, fixed deposit. All these are asset classes. So we have to look at the risk profile of the customer
And
before
then
we
suggest.
talk about the before we talk about the asset classes. Believe that a recommendation will meet the client's investment objective. So even when we are advising the customer, we have to ensure that the investment advice is as per the customer's requirement. It is not one size fits all. So you have to know the customer very well and then tell him the products which will suit him. Also, that is not enough. This is what I was telling you. SEBI wants that there should be proper documentation so that you can't go back. So there has to be a proper documentation of the investment advice which you are giving to the customer. So document process based on client investment objective and financial situation. So whenever a recommendation is given to a client to purchase a particular complex financial product, such recommendation or advice is based upon a reasonable assessment that the structure and risk reward policy of financial product is consistent with client experience, knowledge, investment objective, risk appetite, and capacity for absorbing loss. So, when we talk about a relationship manager or a wealth manager, it's not only about his ability to sell the products to the customer. It is also his ability to reduce, to understand the customer's objective, the customer's risk, and then give him the investment advice. On the other hand, he also needs to do the KYC of the customer in order to understand his risk to the bank. So he has to, compliance is a very, very important issue of any financial service industry. Whether you're working for a bank or you're working as a wealth manager or a relationship manager for a wealth advisory or in the insurance, compliance is very, very important because the regulations are so stringent, and we've seen this, RBI has very tough regulations. And in the recent past, you would have seen that RBI has been penalizing various banks for not fulfilling the guidelines. So as a wealth manager, as a relationship manager, our duty is twofold. So one is to ensure that we are compliant with all the requirement of the regulators, whether the regulator is RBI or SEBI. In which case the regulator would be SEBI. If we are working in a bank, will SEBI be anyways relevant to us?
Yes, ma'am, when we are talking about equity assets.
Yeah, so when we are giving investment advice to the customer, in that case, SEBI would be relevant to us. Yeah, so we have to know the rules and regulations of SEBI, the instruction guidelines of SEBI, and then do the investment advisory, right? And also for the KYC, we have to be compliant with the RBI norms. So both regulations will apply. So the point I am trying to make here is selling as a skill is important, but in a bank or any financial institution, compliance is also required. You cannot work without compliance. Selling a financial product is not like selling any physical product where you just talk about the quality of the product and are able to sell it. Whenever you are selling a financial product, you have to look at the risk from both point of view, from the point of view of the financial institution and the point of view of the customer. And also you have to look at the suitability of the products. Also, product disclosure. Disclosure is to share all the information with the customer. So just the way when we are opening the account, we expect the customer to do the rightful disclosure. Only then we will know his risk profile, no? So we are expecting the customer to do the right kind of disclosure. At the same time, when we are selling any product to the customer, we are also expected to disclose about the product completely. So apart from acting in the client's best interest, financial advisors also need to ensure that they provide sufficient information about their firm and any proposed investment to the client. Ensure that the client has all information needed to get assured that they are in a position to make a full and informed decision about the suitability of the recommendations made. What constitutes material information will depend on the investment and products being recommended, but would also include areas such as charges, cancellation rights, early encashment penalties, risk warning, and any special or non-standard terms. So when you are a relationship manager, you are expected to maintain a relationship with the customer, a professional relationship with the customer. And we know any relationship thrives on trust, right? So you also have to build that trust with the customer. And any idea how do you build trust? What are the ways of building trust? How trust is built?
Ma'am,
In our
through the
everyday life,
completion
yeah.
of their conditions.
Ma'am, our actions.
Yes, yeah. Your actions, your commitment. If you meet your
Yes,
commitments, trust is built.
Timing.
If you don't, and time also, yes. So there are relationship managers who, when they change their jobs, their clients move with them, because with time they have started trusting that relationship manager, and they're not concerned which bank they have the account. They're more concerned about the relationship manager. So yes, time. Also your actions. Infant rightly said, your actions build trust or distrust. So in everyday life also, we trust some people, we don't trust some people. We definitely don't trust people who do not meet their commitments, right? Or whose actions don't speak as their words. Yeah. So it's the same would apply for relationship manager in a bank or an investment advisory. So for building trust with the customer, we have to be honest and we have to disclose all the relevant information to the investor. So the regulation requires an investment advisor to disclose to a client or potential client all material information about itself, including its business, disciplinary history, any form of remuneration it may receive for any distribution or execution services, any form of remuneration it may receive for recommending service of a stockbroker or other intermediary, its holding or position, if any, in the financial product or securities which are subject matter of advice, any actual or potential conflicts of interest arising from any connection with any issuer or product or securities, all material facts relating to the key features of the product and securities recommended, and particularly its performance track record. An investor advisor should also draw the client's attention to the warning and disclaimers, etc. So basically, business, banking or any financial service is a business of trust, and your actions will help you to build or break that trust with the customer. Also, as I was talking about compliance, so you'll, apart from maintaining that relationship with the customer, you also have to be compliant with the guidelines of the regulator. So the regulator can be RBI for all banking related activities, and SEBI for capital market activities, even IRDA for insurance related things. Okay, so you have to be compliant with the regulatory requirements. For that, you have to maintain, you'll have to do maintenance of record and regulatory reporting. So investment advisors have to put in place record retention policy so that key documents are available for inspections by auditor and the regulator. The regulations particularly specify the retention of the following document. So these documents need to be maintained. So obviously, know your customer records. So what will you have in know your customer?
Ma'am, their name, the basic details.
Yeah, so their ID and address proof.
Yeah.
Yes.
So you'll have the ID and address proof.
And their source of income.
Yeah, and their source of income, correct. Then also, not only that, you'll also have to have the risk profile, because
Yes, ma'am.
the products you are telling them is based on the risk profiling you have done. So risk profiling and risk assessment of the client. Then suitability assessment of the advice being made. So first you'll do the risk profiling. Then based on that risk profiling, you will advise the customer for investment. So you need to also keep the record of suitability assessment of advice being provided. Copies of agreement with the clients, if any, and investment advice provided, whether written or oral. So, so basically, we have seen the role of the regulator is to ensure that there is financial stability and there is unbiased working in the financial industry. So you will have to keep records of that you've worked in the best interest of the customer. You have taken enough, you have done due diligence, or you've done whatever you are required to do to ensure that the client is not at loss. So all those records need to be maintained. Also KYC record to ensure that no money laundering or a financial crime happens. So the regulatory regulations particularly specify the retention of the following document. So you should have a rationale for arriving at investment advice, duly signed and dated. Then a register or record containing a list of client, the date of advice, nature of advice, the product, securities in which the advice was rendered, and any fee charged for such advice. All such records are to be maintained either in physical or electronic form and preserved for a minimum period of 5 years. An investment advisor has to arrange for an annual audit to test compliance So audit is basically test if you're doing the same thing, no? So first thing is you'll have to comply, and then you'll also have to get it audited. So an investment, so annual audit to test compliance with regulations by a member of Institute of Chartered Accounts of India or Institute of Company Secretary of India. So basically, just to ensure that you are following the regulation, or you are following the guidelines of the regulator, there has to be an audit by a competent person. Also, to maintain the sanctity of the financial system, the regulator has a redressal or complaint system, because if the customer's complaints are not met, he would stop investing, and that will have a detrimental effect on the growth of the economy of the country. So the regulator will ensure that there is a proper complaint resolution system. So it is most inevitable that customers will raise complaint against the firm providing financial service. Sometimes these complaints will be valid and sometimes not. So they will have unbiased agencies to ensure that the complaints are looked in properly. So for example, RBI has banking ombudsman. So in case somebody has a complaint against a bank, they can go to the banking ombudsman, and banking ombudsman will step in and resolve this to the satisfaction of the customer, and they'll see whether the customer request is genuine or not. And obviously the regulator expects the financial institutions to provide a speedy redressal to the investor. So the regulator requires authorized instructions to deal with complaints promptly and fairly. Financial institutions should have appropriate written procedures for handling expression of dissatisfaction. Whether the complaint is written, oral or written, and whether the complaint is justified or not, as long as it relates to the firm provision or failure to provide a financial service. So the regulators also instruct the financial institutions to have a proper way of handling a redressal process. So the investor should know what to expect. So these internal complaints handling procedures should provide for receiving of complaints, acknowledgement of complaints in a timely manner, responding to those complaints, appropriately investigating the complaints, notifying the complainants of their right to go to the arbitration where relevant. So this is just information, nothing to explain. Basically, we know that the role of regulator is not limited only to passing the guidelines. The regulator also ensures that the investor is not taken for granted. The investor has faith in the financial system, and the financial system work for the benefit of the investor. So that is also the role of the regulator. So the regulator will do take actions to ensure that this happens. Obviously, for fair judgment or fair handling of the redressal of the complaint, an employee of sufficient competence who is not directly involved in the matter that is subject to the complaint should investigate the complaint. The person charged with responding to complaints should have the authority to settle the complaint, include offering redressal where appropriate, or should have access to someone with necessary authority. The responser should adequately address the subject matter of the complaint and where a complaint is upheld to offer appropriate redressal. The firm decides that redressal is appropriate. The first firm must provide the complainant with fair compensation of any acts or omission for which it was responsible and comply with any offer or of redress the complainant accepts. The financial institution should also take necessary steps to ensure that all relevant employees are aware of complaints handling procedures and endeavor to act in accordance with these. And then there'll be complaint occasions where a client is dissatisfied with the response of the complainant and want to take this further by escalating it to the regulator. So clients need to address their complaint to the regulator that has responsibility for specific area of advice or product. So various regulators have a different kind of complaint system just to ensure that in case an investor or a depositor has any kind of complaint, there is a redressal process. So for example, SEBI can accept complaints against any market intermediary that is registered with SEBI. This includes investment advisors as well as others participants mentioned earlier. SEBI has developed a web-based system for logging and tracking investment complaint known as scores, which is SEBI complaint redressal system. The client with a grievance against a listed company or intermediary can file a complaint using scores. Intermediary must also record the action taken on scores. So scores is a system of SEBI to redress the investor's complaint. Then RBI has established a banking ombudsman scheme that enables an expeditious and inexpensive forum to bank customer for resolution of complaints relating to certain services rendered by bank. The banking ombudsman is a senior official appointed by the Reserve Bank of India to redress customer complaint against deficiency in certain banking service. The service is free and maximum compensation can be awarded of 10 lakhs. The IRDA is a regulator of insurance. Therefore, it will handle complaints related to insurance. So IRDA will accept complaints against insurer, brokers, intermediaries, and others. IRDA also have an online complaint system known as Integrated Grievance Management System that can be used to record complaints about life and non-life product, process of a proposal, policy, servicing, or claims. So just to sum it up, we know that there are guidelines by the various regulators and all financial intermediaries need to follow those guidelines. Not only the regulator have the guidelines, it is also serious about the guidelines being followed. So there are periodic audits for that. They also have their own complaint redressal mechanism to ensure that the investors or the depositors don't feel cheated or they are not at the losing end. Okay, so that is what it is. Why do you think the regulators will be so serious about complaint redressal? Why the complaint redressal is important?
Complete redressal is important for
So that
the gaining the trust of the customers.
Correct. What will happen if the investor does not have trust in the financial system?
They will not invest in the financial system.
Yeah, and then what will happen?
For the it will not good for economy when we didn't invest.
Correct. So I hope all of you get the relation.
Yes.
We know the economy grows when the money is channelized. Now, if people don't trust the system, they will not put in their money. If the money is not channelized, new businesses will not come up. New businesses do not come up, then employment will not be generated, which is the problem of India, very big problem of India, right? Unemployment, people will not have money to spend. Again, the economy will suffer. So therefore, the regulators are very, strict on the regulations to maintain the sanity of the system, to maintain a fair working of the system. So now let us look at regulations governing deposit products. So the banking deposits are governed by the Banking Regulation Act, which is the umbrella act under which banking works. It also defines the work of a bank. It also talks about the activity which can be undertaken by the bank, and also the activity which the bank cannot do. So banking regulation talks about both. It talks about things which can be done and which cannot be done by the bank. The Banking Regulation Act also gives power to RBI. So, Banking Regulation Act is a very important act regarding the working of the banks. So about 80% of the bank resources are contributed by deposits. So I think, I hope all of you can, recollect when we were looking at the balance sheet of the bank. Where would you see the deposits? In the balance sheet of the bank?
Liabilities.
Yeah, liabilities. If you remember, when we were looking at, correct. When we were looking at the balance sheet of a bank, we saw that the major liability of the bank were the deposits. About 80% of the bank resources are contributed by deposits. And RBI is empowered to regulate, and banks are free to work within the broad guidelines of RBI. So we know, we have understood LPG, liberalization, privatization, and globalization. So in that era, RBI removed a lot of regulation, but still Indian banks are regulated. They are broadly regulated by RBI. So in certain cases they have a free hand, but in certain cases RBI steps in and says, no, this is what you need to do. So RBI has empowered the bank, but at the same time they are still regulated. So for deposits, the bank should issue a term deposit receipt or a statement. These days, bank usually don't issue a receipt in the sense a proper receipt, because you have electronic records. So, however, they should issue a statement which shows that the customer has kept a deposit. Term deposit should be freely transferable from one bank to another. Disposal instruction of deposit should be obtained in the application form. That means how should the money be paid after maturity, or if it is a premature closure, how the money should be given to the customer. That should be taken in writing from the depositor. Also, this is, yeah.
Ma'am, in terms of certificate of deposit and term deposit, certificate deposits are more transferable, more negotiable rather than term deposit.
No, they are not. No, they are not transferable in the sense the bank should not, restrict the customer from closing the deposit and moving it to another bank. They are not transferable.
Can you please repeat it?
Freely transferable would mean that they can be moved. The money can be moved from one bank to another. It is not that you can transfer it in somebody else's name. That is not possible in a term deposit.
Okay.
They are not transferable like that.
Someone else, but they were transferable from bank to bank.
They are transferable from bank to bank. So I have a fixed deposit in ICICI Bank. It matures, and now I want to do it with HDFC Bank because it is providing me better interest. The bank should not prevent me. That is what it means. It doesn't mean that I can go and give it to you in your name. Yes. That is not possible. Okay. Yeah. On disposal, obviously, how the deposit should be treated. The instruction should be taken from the investors. Bank to notify customers the impending due date of maturity. Facility to withdraw term deposit before the maturity date. So we know that we can withdraw, though we say it's time deposit, we can withdraw the money in case of need. The bank allows it. However, the bank might charge some penalty. The penal rate should also be made known. So when I make a fixed deposit, the bank should inform me, or it should display that in case of premature closure of the deposit, what is the penalty I'll have to pay. Also, to prevent money laundering, the bank has the RBI has some guidelines regarding acceptance of deposits. So any deposit of more than 20,000 cannot be accepted in cash. So customer can pay via electronic transfer or via check, but It cannot be accepted in cash. And similarly, a customer cannot be paid in cash. So customer cannot be paid in cash a cumulative amount of greater than 20,000 in a day. Renewal of overdue deposit should be non-discretionary and non-discriminatory. That means, certain times the banks have a cutoff period saying that if you come after this date, your FD would not be renewed from the date it matured. So for example, my FD matured on 31st of August and bank has a cutoff date of 14 days. Now, if I go between 1st to 14th of September, they will renew it from 31st. But if I go after 14, they will not renew it from 14. They will renew it from the day I've gone. So certain banks have criteria like this, but this criteria should be fixed. It should be the same for everyone. It is not that they have a separate policy for people working in a certain company or people working for their bank and a certain policy for somebody else. So it should be non-discretionary and non-discriminatory. Bank should allow addition or deletion of joint names of joint holders. Obviously, there is a maximum. The maximum is 3. So in case a customer has opened a fixed deposit in single name, subsequently he wants to add somebody else's name, bank should allow it. Bank should give acknowledgement at the time of submission of Form 15G and 15H. Now, has anybody heard about 15G and 15H? What are these forms? Anybody is aware? No.
No, ma'am.
No, ma'am.
Okay, so let me explain to you. Now, when we are keeping fixed deposit with the bank, we are earning interest, right? Now, whenever we
Yes,
earn
ma'am.
income, what comes with income?
Interest.
इनकम के साथ इंटरेस्ट
Interest.
आता है ऐसे क्या?
नहीं.
एफडी के साथ इंटरेस्ट आएगा, इनकम के साथ क्या आएगा?
Profit.
इनकम इज प्रॉफिट, नो?
Yes, ma'am.
प्रॉफिट के साथ क्या आएगा? What accompanies income and profit? Tax.
Oh, yes, tax.
Yeah. So wherever there is an income, there is an income tax.
Yes, ma'am.
Right. So as per the income tax as of now, income tax provisions as of now, in case a customer earns more than 40,000 interest in a financial year, the bank has to deduct TDS. I don't know if I've explained this to you, but I should ideally have explained when we were looking at NPS and all.
Tax deducted source.
Yeah, TDS. So tax deducted at source. Now the source is the bank. You've kept a deposit with the bank for which the bank is paying you an interest. So source is the bank, right? Now, if your deposit is more than 40,000 in a, if your interest is more than 40,000 in a year, the bank is supposed to deduct TDS. Okay. However, that might be your only income. So, for example, somebody is this is for people under the age of 60, I think, and people who are above the age of 60, it is 50,000, right? So, suppose there is a person who's retired, but his only source of income is the interest which he earns from the bank, or his total income is not taxable. So we have seen that in India, the income is taxed as per various slabs. Total 2.5, 2,50,000, there is no tax. And from 2.5 to 5, it is 5%, then 5 to 10, 5%, and then 5 to 10, it is 20%, and 10, it is 30%. So something like that. Okay. Now, the bank has to deduct TDS. But in certain cases, the investor might not be required to pay any tax. In that case, the customer can give a Form 15G or 15H depending on his age. So, if the investor is less than 60 years of age, he gives Form 15G. If he is more than 60, he gives Form 15H. So Form 15G and 15H are a declaration given by the customer saying that I am not eligible to be taxed. I do not fall in the income tax bracket, and therefore my income should not be taxed. Okay, so they have to do it at the beginning of the financial year. So in case the customer is giving a declaration, it's the duty of the bank to ensure that the bank does not deduct any tax. Right, so they have to give an acknowledgement to the customer for submitting Form 15G and H. So just to
Ma'am,
recap, yeah.
ma'am, provided this is the only source of income for them.
Yes, but then the bank does not have to act as detectives. Yeah. So here we have to ensure that we are bankers. You have to remember that we are bankers. If a customer is giving us Form 15G or 15H, it is between him and the income tax.
Okay.
The only thing is if the total income in the bank is more than, if it is coming more than 2,50,000, obviously then you will not accept 15G, because then automatically we will be in the tax bracket, right?
Okay.
So even if it is like 1 lakh, you will not question, because then it is between him and the income tax. So banks are not supposed to keep Form 15H or 15G with themselves. They have to submit it with the income tax authorities. Okay. So then if the customer has given a wrong declaration, bank will not be responsible. Income tax authorities will be responsible, or the customer himself will be responsible. So the bank's job is, if the customer is giving Form 15G or 15H, they will simply accept it and give an acknowledgement, and then submit this form to income tax. So basically, if you look, when the bank is deducting TDS, is it deducting it for itself? What role the bank is playing? When the bank is deducting TDS, what role is it playing? It is basically acting as an agent for the income tax authority.
Yes, ma'am.
Right?
Yes.
Yes.
So again, when the bank
Agent
is
of third party.
of 15G or 15H, it is accepting as an agent of the income tax authorities. Now it becomes a matter between the customer and the income tax authorities. Right? The bank has to simply accept Form 15G or 15H submitted by the investor. Okay. So these are Form 15G and 15H are declaration by the customer not to deduct TDS. Understood? Any questions on this? Yeah. Okay.
Ma'am, one thing. Ma'am, TDS will be deduct only on the interest what we gain.
Obviously, TDS will only be deducted on the interest. It is never deducted on the principal. Obviously not. It is deducted at source. Yeah, on the not on the principal amount, only on the interest.
Okay. Okay.
Also, if the maturity of the FD falls on a holiday, then the bank will have to pay interest on that, because if it matures on the holiday, the bank will not be able to return this money to the investor. So in that case, they will have to pay interest for that holiday as well. So if that the noted due date of term deposit falls on a holiday or a Sunday or non-business working day, bank to pay interest for such intervening day at the original contracted rate till the succeeding working day. Then saving bank account. So we've seen that the bank asks the customers to maintain a minimum amount in the account, but it might not be possible for every depositor to do it. And especially when the government and RBI are looking at financial inclusion, there might be people who will not be able to keep such high deposits, right? So the bank has to open what is known as BSDBA or Basic Saving Deposit Account, where the bank do not have to insist on a minimum balance. These account can be opened zero balance. Okay. So as part of financial inclusion, bank, I hope all of you remember financial inclusion. We've seen it many times. So what does it mean by financial inclusion? What is financial inclusion?
Ma'am, penetration of financial services.
Yeah. So initiative by RBI to provide financial service or banking access to all strata of the society, and especially the unbanked or underprivileged people staying in the rural areas. So as part of financial inclusion, banks are expected to offer all customer a basic saving bank deposit account. So most of the private banks have minimum deposit as high as 10,000. Some also have 25,000. So it's not possible for everyone to be able to maintain it. So in that case, the bank can open the BSDBA. So bank cannot refuse to open an account. They can open a BSDBA where no minimum amount would be required. So no minimum balance in BSDBA. No number limit on number of credit transaction. Debits limited to 4 in a month. ATM or debit card can be provided. There are charges. There are charges for a BSDBA. I don't know why it is saying no charges. There are charges for BSDBA. And not everybody can open a BSDBA. There the income has to be below a certain amount. So RBI guidelines on KYC norms will be applicable. Customer cannot have any other saving bank account with the same bank. So when a customer comes to open an account, the first thing we will have to do is to check whether he already has an account or no. If he has a saving account, obviously we are not going to open another one. Then intra-bank deposit accounts portability. That means accounts can move from one bank to another. Within the bank, if you have to transfer, so for example, you stay in Bombay, you get transferred to Delhi. There's no need to open a new account. The same account can be transferred to Delhi without the change in the account number. So, portability, all of you would understand it because we talk about mobile number portability. What does it mean? What does portability mean?
Portable means
Ma'am,
Easily
from
locomotive, easily.
Yeah.
transferable.
Transferable without the change in
number.
number. Right. So that can happen with the account as well.
Yes, sir.
Your account number will not change, but
That will be transferred to
the
once the
branch will
transaction.
change. It can be transferred without changing the account number. Also, passbook. If the customer asks for a passbook, then it should be given. Earlier, private sector banks were not giving passbook to the customer. They were only giving statements. And some of the, at least the older generation was facing a problem because they could not correlate the statement. So in that, RBI has made passbook mandatory. That means in case the customer asks, banks will have to provide a passbook for the saving account.
Ma'am,
Do you
for
have a
private,
passbook for a fixed deposit? Will you have a passbook for a fixed deposit?
No, ma'am.
You
Certificate.
will not have a passbook for a fixed deposit. You can have for a recurring deposit because there are many transactions.
Yes, ma'am.
But you will not have a fixed deposit, a passbook for a fixed deposit. Passbook is to record the transaction. Fixed deposit, you will have only two transactions: one opening of the account and second closure of the account. Right? So 2 copies of photograph of all person authorized to operate the account, including Pardanashi women. So even Pardanashi women have to give photographs, and now it's a provision that the Pardanashi woman can have the photograph in presence of a female employee of the bank, but photograph is essential. photograph cannot be substitute for specimen signature. Specimen signature is required. You just can't present your photograph for withdrawal or for doing transactions without the specimen signature.
Ma'am.
Yes. Yes, Akshay.
Ma'am.
आपकी आवाज नहीं आ रही है. I can't make out
Hello.
what you're saying.
Hello.
I can't make out what you're saying, Akshay.
Ma'am.
Speak.
Okay, ma'am. That on chat box.
Write in the chat box. Okay.
Yeah.
Ma'am, what is Pardashi women?
Pardanashi women are women who do not come out of a veil. So especially in the Muslim
Ma'am, I
culture,
was asking.
there are certain women who do not expose their face to anybody but people of their own family. So they remain in a veil always.
Okay.
So earlier, Pardanashi women would not give a photograph. But now the bank insists that the Pardanashi women give a photograph. But if they have a problem, they can have the photograph clicked in presence of a female employee of the bank.
Okay.
So those are Pardanashi women. Parda is basically curtain.
Okay. That veil wear
Burqa,
by
the people, yeah, burqa clad women.
Okay, got it.
So I'm sure the percentage of these kind of customers would have reduced for the bank, but still, in case there are some people like that, then they will also have to give a photograph. Also, when a minor is opening an account, we have seen that the minor account is opened based on the documents of the guardian. So the photograph also would be of the guardian. The photograph obtained would also be of the guardian, because the minor's photograph will keep on changing every 6 months, every 1 year. So photograph, and only when the minor turns major will you take the photograph of the minor now turned major. Okay. So guardian photograph should be obtained in case of minor accounts. Terms and conditions should be transparent and made known to all depositors. Brief, intelligible transaction particulars should be captured in statement of account and passbook. It is very important, because if you don't, you do not make the right kind of notation, the customer would come back. So, for example, you have just written credit. The customer will come and ask what credit. So it's better to write credit by cash or credit by check, so that you don't give rise to any kind of more queries. So brief, intelligible transaction particulars should be captured in statement of accounts or passbook. Provide monthly statement of accounts. Statement should carry address, telephone number of branch, microcode, and IFSC code. These are the codes to identify the bank. Acceptance of check bearing a date as per national calendar for payment. So you cannot pay a non-dated check, because the date on the check has reference to the payment. So the date of the check basically tells you on which date the customer has instructed you to make the payment. You cannot pay before the date on the check, and also you cannot pay a check after 3 months of the date. So the date is very important in a check. So the bank should accept checks which bear date as per the national calendar for payment. Also, multi-city payable at all branches checks to be issued by CBS enabled branches. Now, this concept is very new for you guys, but there was a time where a check could be collected only in the city it was drawn. So, for example, I am based in Pune. I have to make a payment in Delhi. I cannot send this check because a Pune check will not be payable in Delhi. This check can be accepted or paid in Pune itself, but it cannot be paid outside Pune, because only the branch where I had the account had the access to my account. Only they would know if the signature would tally, or I have sufficient balance, or my check is in order. Now, most of the banks are using core banking solution software now. So core banking solution has brought the data at one point. Now all banks have access to the information wherever they are. So even Delhi branch will have access to the database of Pune branch. So now these checks can be paid in Delhi as well. So these are multi-city checks. So checks which can be paid in any city are multi-city checks. So now, because we have this facility, so the benefit should also pass to the depositor. Therefore, the bank should issue multi-city payable checks or at all branches to be issued by CBS enabled branches. So CDs are a money market product, but these are a borrowing product for banks. They were introduced in India in 1989. A CD is a negotiable money market instrument issued by a scheduled commercial bank or a select financial institution. So they are issued in dematerialized form or an uses promissory note. Issue against fund deposited at a bank, other eligible financial institution. Issued for a specific period of time at a market determined discount rate. So we have seen CDs are issued at a discount rate of the face value. At maturity, the investor would get the face value, but what he pays is lesser than the face value. The difference between the face value and the cost price is his profit. So face value is payable on maturity by issuing bank institutions. CDs can be issued to individual corporation companies, etc. CDs can be issued at a discount of face value. So I was telling you, I remembered 5 lakhs, maybe it is 1 lakh. So banks have freedom to issue CDs based on their funding requirement. Minimum deposit should not be less than 1 lakh, multiples of 1 lakh thereafter. The maturity period of CD issued by a bank should not be less than 7 days and not more than 1 year. So we've seen this. Banks are also allowed to issue CDs on floating rate basis. Now, do you understand what is floating rate? Floating, what do you understand by floating? Or what?
That means
Ma'am.
that can be flow.
Changing.
Something which changes. Fixed.
Yeah. Yes, ma'am.
Right? Fixed is where the interest would be fixed. So for example, I have lent my money at the rate of 8%. So until my money is paid, I will get 8% interest per annum. But then there can be floating rate. Floating means it will change as per change in the interest rate. So if you remember, when we were looking at fixed income securities, we had looked at inflation index bonds.
Yes, ma'am.
Do you remember anything of that?
Means they were affected by the inflation rate.
Yes. So the interest rate would change every time there is a change in the inflation rate. So those are floating rate. So floating rate floating rate instruments are instruments for interest rate change as per the change in a variable. Right. Now here, issue bank is free to determine the discount or coupon rate. Banks are required to maintain the reserve requirement, that is CRR, SLR on the issue price of the CDs. I hope you understand the last statement. What is CRR and SLR?
Cash reserve ratio and the statutory
What is it?
Ma'am, SLR is
Ma'am, cash
ratio of liquid assets.
Okay, good.
50% of the
Divided by the time
and CRR is the ma'am ratio
time
of
liabilities
cash.
into demand liabilities.
Correct. And you have the CRR is the cash reserve ratio. So even if the bank is accepting CDs, if the bank is accepting money through CDs, it will have to maintain CRR and SLR. It will be added to the demand and time liability. So we know this is a liability. The bank is accepting money, no? So this bank is borrowing. So this is also a liability. So this would be added to the total deposits for calculation of your demand and time liabilities. So CDs, banks should issue CDs only in dematerialized form. That means no physical certificate should be issued. It should be issued as a book entry. CDs in demat form can be transferred as per the procedure for demat securities. There is no lock-in period for CDs. Bank FIs cannot grant loan against CDs. Why do you think this? So you can get loans on FD. Why can't you get loans on CDs? What is the problem? Why can't you get loans on CDs?
They are in dematerialized form.
No, that is not the reason. Your FD can also be in dematerialized form.
Okay.
Because they are transferable. Why will you want a loan? Because of liquidity. But
Yes.
liquidity here is not limited. In FD, we know there is a penalty. But here they are not transferable. CD is transferable. So other than taking a loan, you transfer it to somebody else, and create that liquidity. So banks FI cannot grant loan against CDs. Further, they cannot buy back CDs before maturity.
Ma'am, since CDs are not transferable, we can't grant loans.
CDs are transferable. That is what we've seen, the difference between fixed deposit and CDs, no? CDs are freely transferable.
Yes.
So that's why, you will not grant loan because they are transferable. Why will somebody take a loan? Loan is taken only for liquidity. You can generate the liquidity by transferring your CD. Why is that you want to take a loan on the CD? That is the logic. So, however, investors have the option to seek the certificate in physical form also. So, customer can take the CD in dematerialized form or in physical form. So, for example, if somebody wants to give you money, you can either take cash or you can ask him to transfer in your account. You have that discretion. So, the same discretion the customer would have to either take the CD in physical form or in electronic form. In physical form, the CDs are transferable by endorsement and delivery. So we'll understand endorsement and delivery when we are looking at check. Endorsement is adding something and delivery is giving. So if you have to transfer it, it can be transferred by endorsement and deliveries. CDs issued in form of usance promissory note attract stamp duty. Physical certificates are presented for payment by the last holders, payment to be made only by cross check. So different from fixed deposit, we had already seen the difference between fixed deposit and CD. CD is not mere receipt, whereas a fixed deposit certificate is only a receipt. Fixed deposit is not negotiable, CD is negotiable. That means it is freely transferable. CD is a money market instrument. It is traded in the secondary market. So I hope all of you remember primary and secondary market.
Yes, ma'am.
What is primary market?
In primary market is a market where the company issued its first time.
So for the money for the CD, what will be the primary market? What will be the primary market for a CD?
Banks.
When the bank is issuing the CD for the first time, it's the primary market. When the existing investor is selling it to another investor, it's the secondary market. It is paid on due date of and the place of issue. Cannot be encashed before maturity. Is governed by RBI guidelines relating to period, negotiability, amount, etc. So that's I've told you. RBI is a regulator of money market, and CD being a money market equipment would be regulated by RBI. Also, it is issued by a bank. So again, regulator is RBI. So it's governed by RBI guidelines relating to period, negotiability, amount, and it attracts stamp duty, which is issued in physical format. Now, so these are, so if you look at the basic business of the bank, the basic business of the bank is to borrow and to lend. So bank has various options to borrow. It can borrow as demand deposit. It can borrow as fixed deposit. It can also borrow as certificate of deposit. and then it lends out loan. The earning of the bank is the difference between the lending rate and the deposit rate. That is one form of income for the bank. Okay, if you remember the income, expenditure statement of the bank. Okay, now every business would want to improve profit, and what are ways to improve profit? If you are in a business and if you look at improving your profit, what are the various ways of improving profit?
Either we decrease the cost of production or increase the
Okay.
SP of a product.
Okay.
Increasing the sales.
Increase in the sales. Okay, good. So increase in sale is one way of increasing your profit. Good.
Yes,
Any other reason by any other way of increasing your profit?
reduction in the cost of production.
Okay. But in bank, you can't do it because the interest rates are market driven. You
Okay,
cannot
ma'am.
definitely reduce the interest rates which are you are paying to the depositors, or increase the interest rates which you are charging to the investors. You understand, no?
Yes,
There is
ma'am.
not a competitive advantage. Yeah.
Yeah, in banks, I think sales, I mean the selling of other
Not
products.
only in bank, not only in bank, in
Yeah.
any other business.
Yeah,
If you look at your, the corner shop near your house, and it will be relevant to everyone, whichever part of India you stay, it will be relevant. So a small shop which used to sell only, say, groceries, now is also selling bakery products.
Yes, ma'am. It
is
will.
also selling, they are also selling SIM cards, and if you go into rural areas, they will also have a banking correspondent sitting there. So they are also selling, bank account.
Yes,
So one way of increasing profit is to sell multiple products to increase your product line.
Yeah, cross-selling of products.
Yeah. So this is one way of for the bank to generate profit. Another way for the bank to generate profit is to sell multiple products. Now, if the bank manufactures this multiple product, or bank or any other company manufactures these multiple product, it will also increase the risk associated. So here the bank says, no, I'm not taking any risk. What I will do is I'll take a product from someone and sell it to my customer. So it's not any different than Big Bazaar. If you go to Big Bazaar, which I'm sure all of you have gone sometime, you'll see there are Big Bazaar products, and they are products of other companies as well.
Yes, ma'am.
So where Big Bazaar does not have to take any pain of manufacturing, packing, this and that. The only thing they have to do is sell it, right? And that is what the bank does. So bank sells third-party products. Now, why third party? Because these are not bank products. Two parties are the bank and the customer, and the third party is the
whose products are
the bank is selling. So the bank sells third-party products, which can range from insurance to
mutual funds,
to government bonds, to collection of income tax. So anything to do with money. So bank does it to improve their profits and also reduce their risk, because these are not products of the bank. So in case there's a problem, the customer will go to the third party, right? So your third party products or services, where the bank acts as agent of third party or financial service provider in marketing and distribution of various third party products. So the advantage, it is advantages for everyone. It had advantages for the third party because they will not have such strong database. So they get access to the bank database. So it becomes easier for them to sell their products. For the bank, it adds to the stickiness of the account. What we call in marketing, we call stickiness of the account. That means the customer will stay for a longer period of time. So for example, you have a friend who can help you only with one subject. He can help you with English. And there is another friend who can help you with English, math, science, history, and he can also help you if you are participating in some extracurricular activity. So friendship with that person who can help you in many things will be stronger than the person who can help you in one. Yeah, so that is what the bank does. So the bank gives you a saving account. Then it also gives you an insurance whose premium will be deducted from the saving account. It also gives you a government bond whose interest will be credited into your account. So now it becomes difficult for the investor to, for the customer to go. So selling third-party product is beneficial not only for the third party but also for the bank. Is there any advantage for the customer also, or the customer is being taken for granted? He doesn't have a choice. Will there any advantage for the customer as well?
Yes, ma'am. Customer get all the products on the one.
Correct,
under the
correct.
one.
Yeah. So for the it is beneficial for the customer as well, because the customer is getting the product and all the product under one roof. So it is beneficial for everyone. And as I was talking about in the earlier part of the session, the banks are trying to become universal banks. That means they want to help you with all kind of money related thing, whether you want to save it, invest it, spend it, take a loan, whatever you want to do it through a bank. So distribution of third party products also widens the bank's job towards investment. So if somebody wants to invest, there also the bank, the bank can help them. So bank acts as an agent for third-party financial service provider in marketing, distribution of various third-party product. Vast network and captive customer base. Started with retailing government securities, helped in enlarge the market for government securities. Banks were permitted to market mutual funds. Facilities made available only with select. So banks were subsequent to insurance agency business. However, banks to disclose various commission, other fees received. So we have seen it in the earlier part of the session also, where we saw whenever a investor advisor is earning any kind of money from the advisory business, that has to be disclosed to the investor. So banks are to disclose various commission fee received. Draft guidelines have been issued by RBI to protect customer from mis-selling and conflict of interest. Addresses the need for adequate grievance resolution mechanism. Operational risk arising from weak internal control mechanism. Also, to avoid money laundering, there is a restriction on the cash which can be taken. So cash cannot be taken for more than 50,000. Right, so transaction above 50,000 only through debit to the account of the customer and stricter KYC AML norms. So wherever there is a financial service, there is bound to be the risk of AML, and therefore stricter KYC norms have been set up to ensure that money is not laundered. And in the bank also, you will find such customers. They will come and say, I'll give you a lot of investment, but I will give you in cash. Please don't fall for such claims. It can be very dangerous. It can be a case of money laundering. So let us now understand third-party products, mutual funds, insurance product, and financial planning in little more detail. So if you look at the working of the banks have changed drastically. Earlier, it was more transactional. So you went to the bank to deposit. Means you guys might not have seen it because you are born in a different era. But earlier, if you talk to your parents or your grandparents, they'll tell, bank job involved an entire day work. So for example, if your father had some bank work, he would take a leave and then go. But we don't do this because we can do those things from the comfort of our house. So earlier banking was very different, where everything was done from the branch, and therefore there were a lot of people there, and they used to the interaction between the customer and the banker used to be just transactional. However, in the past few years, I will say not few years, 20 years for you, some of you, it would be a lifetime. So in the last 20 years, the way banking is done has changed. Now, all these regular things have been automated. So you don't need to go to a bank to withdraw cash. Also don't need to go to the bank to deposit cash. You can do it through the ATM. Also, you don't need to go to the bank to you deposit a check, because you can easily accept electronic payment. And or you can also similarly do electronic payment. So the job of the people working in the bank have changed. Now they don't have to work on the transactions. They now have to work at relationship building. And this is also given time for them to talk about investment and third-party product to the customer. Earlier, I remember, I'm talking about 2004. I was in a branch which was in the marketplace, and at 11 o'clock, if you just raise your head, you will see only human heads across the branch. It was a big branch in a central place of the city, and there used to be around 2,000 or 3,000 footfall each day. And
Which city, ma'am?
in Lucknow, even in Bombay,
Oh,
Nariman Point, that was the case.
it was around 16, 17 years back.
Yeah, 16, 17 years back. Yeah. So that was the case. But in today's time, you will see the branches are deserted. So it's not that the bank has stopped recruiting people. So earlier, if you were sitting at the counter, the only thing you were expected to do was to help the customer complete his transaction. But that is no longer required. In today's time, the requirement of the banks have changed. They're still recruiting people, but they're recruiting people to manage relationship with the customer. So you can go and check the kind of job profiles available in a bank. So relationship manager would be a very common job profile available with most of the bank, because now they don't want transactional banking. So all of you, if anybody has come, so this is a very small batch, but anyways, if you have come with an intention of sitting at the counter and counting cash, you are set for a disappointment, because that kind of jobs are not available in the bank. So even if you have to count cash, there'll be only say 50 transactions or 60 transactions in a day. You don't need one person doing only cash. So you're required to build a relationship with the customer to sell third-party products. So you guys, all of you will have to be open to doing this, because this is the only kind of job available in the bank in today's time. And if you don't trust me, go and check. In today's time, we have access to information. So go and check at you just type in banking job for freshers. Just type in this and do a Google search. You will get all the banks. So whether it is HDFC Bank or Axis Bank or ICICI Bank, all other kinds of banks, IndusInd, Bandhan, IDFC, whatever bank you can think of, the only kind of job is required will be relationship managers. You will hardly find. So, you can take it as a homework. Maybe we can discuss it if not tomorrow, we can discuss in the next session. To tell me what are the kind of jobs available in the market today for bankers or for fresh graduates. Okay. So we have to move from transaction banking to relationship building, and which involves understanding the requirement of the customer and selling financial product based on the requirement of the customer. So that is all about third-party products and service and financial planning. Everything is dependent on relationship building with the customer, because these are financial products. These are not your physical products which cost 500 rupees, 600 rupees, which you can sell to the customer. These are things which require a huge commitment in terms of money and in terms of time. Right? So for that, obviously, you have to have a good relation with the customer to sell these products. And there is where the career of the bankers lie today. Okay, so if you are able to do it till tomorrow, it is good. Otherwise, if you want to take time, we can discuss it in the next session. I want you to see what are the jobs available for freshers in banking industry today. Okay, so do some research. So third-party products, you've all understood. Can somebody tell me what are third-party products?
Insurance, mutual funds.
Okay, can you define third-party products? So you're giving me examples. Define third-party products.
The products which are not which are sold by bank but are not the product of the bank.
Correct. So the third party products are products of some other company or some other entity, but these are distributed by the banks, or banks acts as an agent for another company. So we know we've understood the function of the commercial bank. So we've seen the first function of the commercial bank is borrowing for the purpose of lending. However, in today they also provide financial service. So this chart tells you the key function of the commercial bank. So apart from financial intermediation, now what is financial intermediation? Financial intermediation. What is financial intermediation?
A financial intermediary.
Yeah.
It
What
is
does
a
it mean?
it is a link between.
Yes, so financial
It is the
intermediation is the link between people who are in surplus and people who are in deficit. So this form, this function of the bank we have understood clearly. Now, bank is also the part of the payment system, right? So if you have to pay money to someone, it has to be routed through the bank.
Yes, ma'am.
Though we have payment banks today, but nonetheless they are banks. So bank is the backbone of the payment system. And apart from that, in today's time, bank also provide financial services, right? Some of the products can be their own. So for example, ATM card, credit card is their own, but they also sell third party products. So these are the three basic functions of the bank. And this is one question which I often ask you in your mock interviews. What is the functions of the bank? And you need to understand it very well that, I get very irritated when people after attending 4 months of classes tell me बैंक में ना अकाउंट भी खुल सकता है, लोन भी देता है, चेक भी देता है, कार्ड भी देता है. That is what not we have learned. We have seen in a very structured way that bank is a financial intermediary. It is the constituent of the payment system, and it is the seller of various financial services. So that is what is the function of the bank. After spending considerable amount of time in the Marticus, you should be able to explain this now. Okay, so this is the function of the bank. Okay. So key role is to satisfy financial needs of the sector such as agriculture, industry, trade, and communication. Play a very significant role in process of economic, social needs. Basic trends, a bank now aim to be customer centric and widen their scope of function. So we have seen this in the earlier session also. The banks have to be customer centric. What would customer centric mean?
Means it's all working or revolve around the customer.
Correct. Customer centric means the customer is the center of all your endeavors. Whatever you do, you keep the customer in mind and then do it. So for example, you're selling a financial product. It will not depend on the product. Just because I know about mutual fund, I will go and sell mutual fund to the customer. Not correct. I will sell mutual fund to the customer only if it suits the customer. I have done a suitability check for the customer. So my efforts or my endeavors have to be customer centric. So that is the banking trend. That's why relationship manager or wealth management has become important. So even if you look at the title of this course, what is the title of this course?
Certification in banking and wealth management.
Yeah.
Yes, sir.
So that is the function of the bank. So the bank also performs agency function when it works for somebody else, when it acts as a representative or an agent of some other entity, and utility functions. So along with primary functions, each commercial bank has to perform several secondary functions like agency function and utility functions. So agency functions, the bank also works for the customer. So when the bank collects and clear checks, dividend and interest warrants on behalf of the customer, it is acting as an agent of the customer. Also in today's time, the bank provides various payment services like making a payment of rent, insurance premium. Again, the bank is acting as an agent. Then deal in foreign exchange transaction, purchase and sell securities on behalf of the customer. The bank can also act as trustee, attorney, correspondent, and executor. Bank can work as an agent for the government to accept tax receipts and tax returns. So these are agency functions. To define agency functions are functions which the bank does on behalf of someone else. Then general utility functions can be provide safety lockers facility to the customer, issue traveler's check or travel card, accept various bills for payments, act as referee in case of arbitration, provide various cards such as credit card, debit card, smart card, provide merchant banking facility. Do you remember what is merchant banking facility? What is merchant banking?
Trade
Merchant banking.
means merchant means
Ma'am,
trade.
is it the retail banking?
No.
No. Means it sell the products.
No. It is nothing but investment banking.
Oh yes, yes ma'am.
Merchant banking is investment banking. So banks can also perform function of investment banks. So though investment banks don't perform the functions of commercial banks can perform the functions of investment bank, which is merchant banking services. Okay. Then also provide money transfer facilities. Yeah. So one of the most important product which the bank expects the employees to sell is insurance. Two reasons for this: because India as a country is underinsured. That means people do not have enough insurance. So if you go and directly sell an insurance to the investor, he'll say, no, I have enough insurance. And if you ask him what is the insurance, he'll say 10 lakhs. But nobody understands what does 10 lakh means. 10 lakhs as an amount sounds huge. But if you look at in brutal truth sense, it means that if this person dies, his family will get 10 lakhs. Now, if a person is say 30 years old, he has a wife and 2 kids, he dies today, his wife and kids will be left only with 10 lakhs. Is that 10 lakh enough to take care of the educational requirement of his children? Definitely not. Right? So most of the people in India are underinsured, and therefore there's a lot of scope for selling insurance. Also, the commission which the bank gets for selling insurance is high. And therefore, there's a lot of emphasis on banks to sell insurance, in the bank to sell insurance. So be open about selling insurance. Now, when I say selling, doesn't mean mis-selling. There is a difference between selling and mis-selling. Do you understand the difference between selling and mis-selling? How selling is different than mis-selling?
Selling means
Selling means what?
Ma'am, mis-selling is something like selling wrong products or something like that.
So if you look at, we had seen we had seen suitability of the product, right? When we were looking at the risk, we had seen the suitability of the product. So if you have seen, you have sold a product which is suitable for the investor, suitable to the investor with all the requisite disclosure, it is selling. If you have not done it, that is mis-selling. So mis-selling is selling using wrong techniques or using wrong practices, right? So yeah, so insurance, if you join a bank, you will be required to sell insurance, but try to sell it in a proper way as per the requirement of the customer. So any person who is a sole bread earner would require insurance. And obviously, as I was telling you, that most of the people are underinsured. That means they do not have adequate insurance. So explain them the concept and then try to sell insurance to them. So insurance, to understand, is the equitable transfer of the risk of loss from one entity to another in exchange for a payment. So we have seen that when somebody buys insurance, he pays a certain amount of money to the insurance company so that the risk is transferred from that person to the insurance company. Now, if this person dies, the insurance company will have to make a payment to his family. So it is a form of risk management primarily used to hedge against the risk of a contingent uncertain loss. So we know life is very uncertain, and especially the COVID time has made us realize that life is very uncertain. You can't plan things now, so you can't even plan a travel or going, the everyday things which we used to do, going out to a restaurant or watching a movie. We can't even plan that. Life has become so uncertain, so insurance is a way to hedge or reduce the risk of uncertain loss. So in insurance, you have two parties involved. One is the insured and the other is the insurer. Insured is the person who is transferring the risk to the insurer. So insurer is taking that risk. So in an insurance, the insured transfers the risk to the insurer, and insurer is ready to do it because he's getting paid for it, right? So the insured or the policyholder is the person or entity buying the insurance policy, and insurer or insurance carrier is the company selling the insurance. The amount of money to be charged for a certain amount of insurance coverage is called premium. So nothing in this world comes free. So when the insurer is taking that risk, obviously it wants to be paid. So the amount which is paid by the insured to the insurance company is called a premium. So insurance protects from financial losses in risk situation. So there are ways of risk management. First is to control, then to avoid, retain, or transfer. So insurance is transfer of risk from one person to the insurance company. So if you're, for example, if you're driving a car, so you drive it in such a way that you don't make an accident, or you just avoid driving a car, or even if you meet with an accident, it's okay. Or you transfer the risk to the insurance company. That means in case somebody meets with an accident, the loss, the financial loss which has happened is taken care by the insurance company. And another thing which we have to keep in mind is the insurance company can only take care of the financial loss. Any kind of emotional or physical loss cannot be taken care. So insurance is a way of transferring the financial loss from one person to another. Right. So insurance work from mutual help proportional contribution. Now you have a contribution by many people, pool in money, and then from this money, the money is paid to somebody if somebody dies or disabled or becomes handicapped, because everywhere the financial ability of the insured would be would decrease, right? So there's a financial loss in all the three things. Now you look at, so I was telling you that there's a lot of emphasis on in the bank to sell insurance. Now why? Because they want more and more people, because if the contribution is many, the probability would decrease. And you will see insurance is sold only, life insurance, for example, is sold for people up to the age of 60 or maximum 65. Because the probability of death here is low. You will not sell insurance to people who are 65 and above, 60 or above, because the probability of death increases as you age. Okay? So people try to sell insurance to as many young people as possible, because so if they have like 1,000 people, they will receive premium from these 1,000 people. In these 1,000 people, if you die, it is okay, because they have earned enough money, because the rest 988 will survive, and probably they will never claim this insurance. So the money would remain with the insurance company. The insurance company would be happy paying it to the family of 2 people who have died, and the rest of the money would remain with the insurance company. So that is basically the principle of insurance, and therefore people want to sell as much insurance as possible because the probability will keep on decreasing. So say the probability of people dying between 21 and 60 is 3%, right? So the more the number of people you have, the more would be the profitability of the insurance company, because only 3% are going to die. The rest of the money will remain with the insurance company. Okay. So this is the working of insurance. So they sell insurance to many people. Out of that, the money is paid back only if some people die or financial position of somebody is affected. So obviously insurance is a contract. It's a contractor relationship. So any BCom student who can explain me a contract? What is a contract? Anyone knows a contract?
Contract is a written document between two parties.
Correct.
Which contains all the legal conditions of the agreement.
Yeah,
and,
agreement is a very important aspect of a contract. So there has to be an agreement. Right?
Yes, ma'am.
So insurance is also an agreement. The insured and the insurance insured have agreed on certain conditions, right?
Yes.
So who is to be insured? Who? The insurance company then does what? Promises to pay a certain sum of money to whom? To the policy holder when on happening of a specified contingency. So only the happening of the event is required. I'm sure all of you would drive or ride a two-wheeler, and every year you would buy insurance for that two-wheeler. You can claim insurance only in case there's a damage to the two-wheeler. Otherwise, your insurance premium would just go waste. I'm sure most of you would have experienced it, right?
Yes, ma'am.
So the insurance company pays only on happening of a specified contingency. However, insurance, as I was telling you, only takes care of financial risk. It cannot take care of all risks. So in an accident, somebody might lose an arm, okay, or might become handicapped. That cannot be taken care by insurance company. Only the financial risk can be taken care. All risks cannot be insured. Law of large number should prevail. So as I told you, the more the number of people buying insurance, the better would be the profitability, or that only then it will make business sense for the insurance company. Like if insurance is sold to 10 people and 8 of them die, insurance company will have to pay it from its own pocket, and therefore it will become a loss making thing for the insurance company. So law of large number should prevail. Also, losses must arise due to certain events. It must be consistent with public policy, and insurable interest must exist. So a wife can take an insurance on her husband's name because she'll be affected in case the husband dies. But I'm a big fan of a film star. I can't go and buy insurance in his or her name because there is no insurable interest which exists. Even if that person dies or is disabled, is not going to affect me in any way. So for getting insurance, there has to be an insurable interest. So, blood relatives can take insurance in each other's name. Employers can take in the name of employees because there's an insurable interest. Yeah.
Ma'am, but I have heard like, say for example, singers, they can get insured. I mean, they will get insurance for their voice.
Yeah. So that is insurable interest for them, no? If they lose their voice, what will happen?
It's the money, it's the finance which they lose.
Yes. So when they say they have insured their voice, doesn't mean that the insurance company will come and restore their voice. That doesn't mean that. It means the insurance company will make good the loss which has happened to them because of their loss of voice. So obviously, if a singer has lost his voice, he will not get any singing contract. He
Yeah,
will lose
because it
his
is
earning
the,
capacity.
yeah,
Right.
because only with this skill he is earning.
Correct. So the insurance company will only make good the financial loss to the insured in case of loss of his voice. So that is what we are saying. Not all risk cannot be insured. Only financial risk can be insured. So I find these insurance ads very funny. So when somebody buys insurance, you see a if the husband dies, the wife is going to get a lot of money. Is the wife very happy about it? I doubt. So I really find these insurance ads uh, really funny, because insurance is a concept that something bad happens and you are compensated for it.
Yes.
You are compensated for it. Right? So that is what insurance is. So insurance transaction involves the insured assuming a guarantee and known relatively small loss in form of payment to the insurer. So I'm sure if all of you have, if you have your two-wheeler, you have to pay certain kind of premium and for taking an insurance. So this in exchange for the insurer promise to compensate the insured in case of financial loss. The insured receives a contract called insurance policy. So it's a contractual relationship. We have seen that it's a contractual relationship. So the policy will have all the details regarding the contract. So policy will detail the agreement between the insured and the insurer, which details the condition and circumstances under which the insured will be financially compensated. And as we've seen, insurance involves pooling funds from many insured entities to pay for the losses that some may incur. The insured entities are therefore protected from risk for a fee, with the fee being dependent on the frequency or severity of the event occurring. So that is what I was telling you. As we age, the insurance premium keeps on increasing, because with each passing year, our probability to die increases. Therefore, the insurance premium keeps on increasing with each passing year. So if the insurance premium which you will have to pay will be much lower than insurance premium which I have to pay because of my age. So you guys are in your 20s will have to pay a very low premium. Okay. So the premium is not fixed. And also, I don't know if you guys would have realized, if somebody is very prone to accident, he will have to pay a higher insurance premium for his bike or his two-wheeler or his car. Also, if you've been reading the newspaper, you would read that there are chances that the insurance premium for health policies will increase. Why do you think that will happen?
Because of death rate was increases because of diseases. That's why the
hospitalization rate was increasing.
Oh, yeah.
With COVID, the hospitalization and the hospitalization expenses were increasing.
Yes, ma'am.
Right? So it depends on the risk the company has to undertake. Obviously, it is a regulated industry. Insurance is also a regulated industry, and IRDA is the regulator of insurance in India. And this is just information. FDI cap on insurance sector have been increased from 26% to 49%. That means a foreign company can invest up to 49% in an insurance company. So insurance can be broadly classified as two insurance. One is life insurance and other is non-life. When we say life insurance, it only covers human life. Human life. If so, for example, I have a dairy farm and I have obviously cattle there. If when any of the cattle dies, I will face financial loss, but I cannot buy a life insurance for that. I will have to buy a general insurance. So life insurance basically covers only human life. Rest, everything is covered by non-life. Okay, so life insurance, as I was talking to you in the earlier part of the session, there are two risks to human life. One is early death and one is late death. So both is covered by insurance. So insurance cover annuities and pension products as well. So life insurance is for the risk of early death. So the example I gave you, somebody in his 30s has a family to take care, dies, his family will not have enough money to take care of the requirement. So he buys an insurance. In case of his untimely death, his family will get enough money to take care of the needs of the financial needs. Also, people buy annuities and pension products because again, life is uncertain. You know, you might live to be 80, maybe 90, who knows? Okay, so COVID has given us more perspective on this. So you would have heard about the people in their 80s recovering from COVID, whereas a person of in his 20s or 30s has succumbed to it. So life is very, very uncertain. And therefore, people try to manage the risk of either an early death or a late death by buying insurance. You know, so life insurance for early death, annuities and pension for late death. Everything else is covered under general and life insurance. So I think I will end the session here today. We will continue to learn more about insurance product in tomorrow's class. In the meantime, if you have any questions, we have a couple of minutes left. If you have something to say, we can discuss it. Yeah.
Ma'am, which is better? Insurance is better or we invest in a money market or capital market?
See, it will depend on your requirement, you know. So for example, somebody is very rich. There's a couple of businesses, this and that, big family to take care. If he doesn't buy insurance, it's okay. You know, he can invest his money. But there's a person who's a single bread earner. Now, if he dies untimely, what will happen to his family? So there's no, right or wrong answer to it. It is very subjective. So basically, you have to just ask one question: what will happen if this person dies? If there is a bachelor whose parents were government employees and they have their pension, okay, if he dies, will his parents need that insurance? No. His parents might not need his insurance because they already have their pension coming. They will not need his insurance. So for him, insurance is not a compulsory product. He does not need to buy an insurance. But if he's married, he has a wife is not working. In that case, he must take insurance because in case he dies, who will take care of the financial requirements? So there is no right or wrong answer to insurance or investment. Both have separate purpose and people should have both. So just because I have investment, I don't require insurance. Maybe. So for example, my husband is working. He's also at a good position. He earns a very good amount of money. I am also working. My children are settled so my children are like midway. If I die, it is not going to affect the financial position of my family because my all my children are almost settled. Their education is complete. My husband is earning. He will take care of their financial requirements. So I might not need to buy insurance. But if there is only one person, his children still have to go and study, they have to be settled, then insurance becomes a compulsory product for him or a requirement for him. So again, financial products, nothing wrong, nothing right. Suitability is important. So that's why if you remember when we were looking at financial planning, we are talking about suitability of the product. Suitability of the product is very, very important. You have to understand that is what relationship management is. You understand the customer, you understand his financial requirement. That is what financial planner or an investment advisor does. Understands the requirement of the customer and gives product according to his requirement. Right?
Yes,
It's a very complex thing. It will not
Yes.
come that easily. But yes, both are financial products. Both have their own requirements. And depending on the situation of the customer, you will choose the right kind of product. Okay. Fine. Anything else?
One question more, ma'am.
Yeah.
That whether to take insurance in the early age or to take after some time, which one is better?
As I told you, the insurance premium increases with age.
Yes, ma'am.
So it is better to take it as early as possible. In case you need insurance, it is better to take as early as possible because the premium would be lesser.
Ma'am, but we thought in case that if we doesn't have that situation that
Requirement.
yeah.
What I'm saying is, in case there's a requirement, so for example, there is a person, a boy whose parents are dependent on him.
Yes, ma'am.
He gets a job. He should immediately, though he's not married, he should immediately take insurance. Because if he dies, what will happen to his parents? His parents are dependent on him.
Okay.
So earlier you buy the insurance, the better it is. Okay, so we are going to talk more about it tomorrow. As of now, bye-bye. See you tomorrow.
Bye, ma'am.
Tomorrow again, 2 o'clock. Bye.